All right, everything looking good. Should be live. Welcome back to the channel, Crypto Trend Trader, with our Friday weekly market wrap-up. Before we get started, I'd like to remind you it's not financial advice. I'm not your financial advisor. These markets are extremely volatile, so please do your own research and trade responsibly. It is 11:31 a.m. Eastern Standard Time on February 25th, 2022. Going to go ahead and jump right into these markets. Obviously seeing quite a bit of volatility. Some of the moves that we were expecting. A couple others perhaps less expected. But overall, nothing has changed. Still trending in the predominant direction that we expected. And we're seeing a couple of those big moves and potential tops or blow-off tops play out. We see that happening in gold in particular. We also see oil, and definitely seeing a similar move in the VIX, at least on the short term. So I want to go ahead and jump right in and take a look at those. What's up, Milligan? Hope you're doing well, brother. Here we go is right. Hopefully you can hear me loud and clear if you don't mind confirming in the chat there. All right, so let's take a look at what happened. Excuse me. All right, so we see on TNX, we had been showing a little bit of stress, kind of consolidating here. We had some bearish divergence showing up on the chart between our previous peak and new peak. We tagged our target of 2.0, and then what happened? We had the Ukraine situation take place, Russia-Ukraine situation, whatever. Without getting into the politics of it, we essentially saw that little bit of a rebound get pretty aggressively taken out. From that point, though, so what was that move? That was de-risking. That was a safety play. Everybody flees to bonds. They run to American bonds because they're afraid. You can't run to Europe because the interest rates are terrible or negative. And also, you know, Europe might be going into quote unquote World War III. And then also, you know, we talked about Canada. A lot going on in Canada. Not a bunch of safety there. Nobody's really running to them for, you know, that safe play anyway. So if Europe's not safe, Canada's not safe. And now the likelihood of something popping off between China and Taiwan now, after seeing the Russia-Ukraine situation, after seeing the Afghanistan, you know, pullout situation, I would say is probably, I mean, it's higher than ever for sure, but I'd say it's probably over 50% now. I mean, it probably was already, but whatever the probability is of, you know, a China-Taiwan situation, I would say after the Russia-Ukraine situation, that it has gone up by orders of magnitude, in my opinion. So that being said, this is what we were talking about the other day, about the currency, about the bond market, etc. So now, all of a sudden, that dollar, that DXY, those American bonds, you know, whatever, anything, United States is looking just a little bit safer right now. So we obviously see people run to the bond market, and then Biden gets on, you know, reads off the teleprompter, shakes his fist, you know, like an angry grandpa. And for the first time in, I mean, probably a decade, you know, sounds somewhat convincing, sounds a little bit stern. So I think that helps the markets. It reassures them a little bit. I think it makes the markets think that the likelihood of a 50 basis point hike in the March meeting is off the table. I think now all of a sudden we've gone from, oh, there's going to be 9 rate hikes, 10, 11, 12. Now all of a sudden it's like, okay, there's probably going to be 3. Maybe they hike once and then stop because it's just too much and the market can't take it. Even with over 7% CPI inflation and, you know, 0% Fed funds rate, the market can't take, you know, 1, 2, or 3 25 basis point hikes. Okay, sure. Regardless, you know, that was the fear play. So we see that fear play with a gap down. Biden comes out, acts tough, shakes his hand at everybody, you know, is actually respectful to the reporters for probably the first time in his career. And then we see, the bond market sells back off. The fear trade kind of, evaporates a little bit. And then we see a rebound. So now here we have the TNX. Obviously, this is our 10-year treasury yield, not the actual bond, not the note itself. We see that have a rebound back above the 8 and 21. So now it's damn near back at the top of the range. So, it basically topped out at 2.065. We're back at 1.982. So it looks like this thing's ready to just run back up here for a third round. So after reclaiming the 8, I think it's likely that we continue higher on this right now. I mean, I would have been completely satisfied with the consolidation, but I think there's definitely a possibility we run back up to the 2.0 range, possibly even higher. I think it's going to be difficult to get above this key Fibonacci level, and a nice little consolidation would probably be the strongest for continuation, but at this point in time, it looks like we're at least coming back up for a retest. So I would not be surprised to see some weakness in the bond market. And now let's also keep in mind that the actual bonds themselves are the promise of future dollars. But with negative real rates, you're locking up that money. So even though I could be strong or favorable or preferential to the DXY, dollars in relation to other currencies, I don't necessarily think the bond market is a good bet, because the difference between the DXY is it's the dollar compared to the basket of other currencies. So it's the cleanest pair of underwear in the laundry basket, as where the bond market is the actual dollars themselves. And not to mention now, the same way that, a stock is just the betting on the price of something over time, the options market is betting on the price of something within a certain amount of time. So now instead of just betting on up or down, you're betting on up, down, or sideways, and you have a certain amount of time for that target to get hit. And that is the same way I look at the bond market. Sure, if you buy a bond, you ride it out till maturity, you get paid, that coupon rate, you get those coupons periodically throughout, and then at the end you get your principal back. But the actual value of your investment in the meantime can change as the price of the bond itself change. So if you're an actual buyer of bonds, like you purchase a treasury bond for $100 and it's a 1-year note, or in this case, we're looking at, the 10-year, you're going to get 2% or whatever you're locked in at periodically throughout that period. So if you have a 10-year at 2% and you paid $100 for it, you're going to get that 2% every single year for the entire duration. But that money is locked up indefinitely for that 10 years, and it's locked up at a loss. We know that because real interest rates are, inflation rates are like, 7% minimum, let's say. So if they're 7% minimum, you're guaranteeing a loss of 5% per year for 10 years. So, realistically, you're giving up half your money if things stay the same for the next 10 years. Your principal will be full when you get it back. You'll still get back your $100. You'll have gotten $2 per year for 10 years. So now you'll have $100. You'll have, another $2 on top of that. Wait, no, I said that wrong. $100. You'll have another $20 on top of that. $2 per year for the 2% interest rate times 10 years. So you'll have your $100. You'll have your 2% per year times 10 years. So you get back your $120, but at a negative real rate, let's say it's 7% per year, you're getting paid 2%. So you're really losing 5% in purchasing power. So without compounding that number, you end up with $120 at the end, but we know that you've lost 5% per year, and 5% times 10 without compounding it is 50%. So you've lost 50% of your buying power. So now what you can buy for $120 is in all reality only about $60 worth of goods. So you put in $100, you get back $120, and then when you go to spend that $120 at the end of the 10-year duration, you only get $60 worth of stuff. So when it's all said and done, your $100 is realistically only worth $60. So you essentially lost roughly 40% of your buying power locking it up because of the duration. So, that's kind of the simplified version of it. Now, the reason the price of the bond matters so much and the interest rate in the meantime, and we see it changing on a chart when it's actually locked in at a fixed interest rate, is because along the actual way, if you decide you want to trade that bond to someone else, the price of the bond is no longer locked at the percent or at the dollar amount that you purchased it for. So if there's a high demand for those bonds, 2 years into their duration and they still have 8 years left, but for some reason a bunch of people want those bonds, now there's high demand for them. So now instead of just turning around and selling that for $100 and people just wanting to get that 2% fixed, coupon rate over the next 8 years, now maybe someone's willing to pay you $110. So you basically are getting an extra 5 years worth of that 2% interest, because now there's someone's willing to pay you 10% higher than what you purchased the bond for. So yes, you always get back the same amount at the end of the duration in dollars, plus the coupon rate, plus your interest payment, essentially. But the buying power is what we're paying attention to. And that's why the actual real value of the bond is so much different by the time a longer duration bond matures, which is why the time factor is so much more important. And then that's where the actual trading of the bonds comes in, and why the actual percentage varies when it's all fixed on a piece of paper. Because think about it as a contract. When you buy that bond, it's a contract. You paid $100 for it. You will get $100 back at the end of 10 years. You cannot turn it in any sooner without, penalties. You cannot get a higher percentage than what you agreed on, no matter what is going on in the economy, because you agreed on that. You cannot get paid back more to make up for the purchasing power you lost, because you agreed on the loan terms, on the bond terms. So only through, the aftermarket trading with other investors, traders, whatever, does the actual value of the bond change, or the interest rate in comparison to the purchase rate price change. Because we know that, and we've talked about this before, and we'll just touch on it real quick. We know that if you paid $100 for that bond, and now someone else is willing to give you, $100 and let's just say $200 to keep it simple. Someone wants that bond so bad they will pay you twice what you paid for it. And let's say when you purchased it, it was at a 2% fixed rate locked in. So if it was $100 and now someone's going to buy it for $200 and it was 2%, now that same 2% of $100, because they paid you $200 for it, to them it's only a 1% coupon, because the purchase price is twice as expensive. Therefore, the coupon price in relation to the investment is half as much. So to them, the bond costs $200, twice what you paid for it, and the yield is 1%. Even though it's still the same fixed payment on it, it's half as much of the principal. In the same way that, in an Evergrande type situation where someone buys a bond for $100, and then now it doesn't look like you're going to get paid back at all. So they just say, holy shit, I'm locked into this bond now for another 5 years at 2%. I really just want to get back as much of my principal as possible and cut my losses. So I'm willing to sell this $100 bond that I purchased with a 2% interest rate. I'll sell it for $50. So someone else can step in and buy that $50 bond from you. You've lost half your principal selling it for that price. They've paid half of what the bond is locked in at. And then on top of that, they will get the interest rate will be double what's locked in on the bond, because they paid half the price. So again, they're still getting that 2% payment on the bond, but instead of paying the $100 and 2% is $2 of that 100, they're getting $50 for that bond, and they're still getting the $2, but that $2 is now 4% of the purchase price that they paid for the bond. And that's, essentially just the trading portion of the market. But now on top of that, you have to keep in mind that if someone actually purchases a real bond and doesn't just speculate on the price of the bonds, if that person bought that Evergrande bond from you and you lost half your principal, you sold it to them, what was $100 for $50 because you just wanted to get your money back. If they rock out that bond till maturity and then they turn it back in and Evergrande is still a company, it still exists, and they honor that bond, they will still get the initial $100 that was put into it. So they will essentially have doubled their money and gotten double the rate of yield along the way because they took that excess risk. So there's a lot more to the actual bond market and trading of these actual bonds versus speculating on the price of the bonds than people take into account for. Because it is 100% a contract that is fixed and does not change. So it's very important to keep that in mind when people are talking about, the interest rate of bonds changing or the price of bonds changing, etc. When it's all said and done, no matter what happens in the market, no matter what speculation takes place, if that bond was purchased for $100 with a 2% fixed rate at the end of that 10 years, no matter who owns the bond, no matter how many times it gets traded, no matter what prices are paid for it in the middle, the government still pays back the owner of that bond at the end that full $100. Exactly. And along the way, the government will have paid out 2% of that $100, regardless of who it goes to and what actual percent based on the purchase price that they paid for it is. So it's a contract that does not change. The only thing that changes, the terms don't change. The only thing that changes is what someone else pays you for it or you sell it to someone else for, and then what percentage of that purchase price the actual yield is. But nothing changes in the contract. The contract is locked in. That is 100% locked in between you and the government. You're just trading it with a third party now instead of the deal between you and the government. Now that person is assuming the deal the same way that, say you bought a house and the mortgage and the rates and everything was locked in. And the only difference is you sell that contract, which is the house and all the payments and everything, to another person. The bank still has that same deal with that person. That person's name is on all the paperwork now and on the house and everything, but everything else just stays the same. The only thing that's different is who's paying it. So hopefully that was a good explanation, because I think sometimes it gets lost. And the same way that we talk about like the spot markets with Bitcoin and buying actual Bitcoin or buying physical gold versus speculating on paper contracts or buying futures contracts or something like that, I think sometimes that gets lost in the bond market with people, because in the end, the contract is locked in. So regardless of who speculates on the terms of that contract or who trades that contract with someone else, in the end, in dollars, the contract is always fulfilled just like it says on the paper, on the certificate. The only thing that changes is how that relates to the purchase price or how that relates to someone who purchases it in, the open market, etc. So when people are speculating on some of these things, I don't think they fully understand the scope of it. So bonds didn't all of a sudden change right here. This is literally just the speculation on the price of the bonds or on the yield in relation to that price when we're looking at this. Everybody's bond still says the same thing on it. They still get paid the same thing from the government for loaning them money. It's still locked up for the same duration. The only difference is what someone is willing to pay you for it based on how the risk change, how the picture change. But if you literally just go and buy a bond, a 10-year bond, and you just put it away and forget about it, the price of that bond doesn't change. The price is, it's still, if you spend 100, you still get back your 100 at the end of the 10 years. If it's locked in at a 2% rate, you still get your $2 payment every year. So regardless of what happens in the actual markets, you still get paid back. But it's important because when people talk about the dollar and they're like, oh, look at this picture of the dollar over the last 100 years. And it's like that chart of an actual dollar bill. And then it's just a giant, chart that goes from top left to bottom right. And you can only see the part of the dollar that's like inside of like the chart price action. And it's like very clearly, they're like, you've lost 93% of your purchasing power. Well, that's what we're talking about here. That if you held the dollar for the last 100 years, 100 years ago, you could buy 90, let's say, I don't even know what we want to talk about. You could buy a bushel of corn. Now that same dollar that you could buy a bushel of corn with 100 years ago, if you go, or a bushel of wheat, let's say, you go buy a bushel of wheat now and it takes, $93 or $100, and before it took only $1. So essentially what they're saying is you've lost a massive amount of the purchasing power because the price of goods has gone up so much through inflation over time, but the dollar has stayed the same. So the only way that that chart is actually relevant to you is if you were earning dollars 93 years ago. Because I'm going to tell you right now, what people forget is that only affects if you just took that money and just put it in, your shoebox or under your bed or in a bank account earning zero interest or something like that. The majority of our dollars, for most people, were earned probably in the last 1 year, 3 years, 5 years, 10 years. If you're old and near retirement and maybe you've had some money in the bank, maybe you've had it in the bank for 50 years. So sure, those people have lost a lot of their purchasing power. Most people don't just have a savings account with massive amounts of money sitting around. They've invested in either stocks or gold or real estate or whatever. People don't just sit on cash. So when people are like, oh, the dollar's worthless, it has lost 95% of its purchasing power. If you go to work and you get your paycheck at the end of the week, it's not like you just lost 95% of your purchasing power from when you went to work to when you got your paycheck. No, nothing changed. It's a week later, or 2 weeks or whatever. You're still getting what you agreed on, which was your wage or your salary or whatever. And you go out and it's still going to buy you the same thing it would have bought you 2 weeks ago when you traded the labor for that, and that's the way you should look at it. You're trading your time, you're trading your labor for those notes so that you can go buy goods with. The only way that deflation eats away or inflation eats away at your money is if you just sit on those dollars for years and years and years. So that's why I always talk about when I have a large dollar position, I'm not investing in assets because we're in the middle of an everything bubble, or some of those dollars are not invested in assets. My whole point is that I have an open option on the market. Basically, it's essentially a put option on everything because I'm betting that everything else is going to be cheaper or something. Maybe it's not even everything. I'm just openly saying, hey, over the next year, let's say I'm going to hold these dollars in my bank account for 1 year. And everybody goes, yeah, but you're dumb. You're going to lose at least 7% of your purchasing power. So when you go to buy everything 1 year from now, inflation says it's going to be 7% more expensive. So now your $100 now is only going to get you $93 in goods at the end of the year. Sure, technically that is true because, CPI is 7%. But what we need to pay attention to is not everything moves in lockstep, in unison, in correlation. So my option is on everything. So some of those things, you're right. Some of those things you are correct. Technically speaking, if I go and purchase a basket of goods that makes up the CPI, and we're assuming those numbers are real and accurate and whatever, just for simplicity's sake, if I go and buy that same basket of goods 1 year later, this year, I lost 7% of my purchasing power on my dollars. Correct. You're right. So I'm dumb. Cash is trash. You're dumb because you lost 7%. End of story. Correct. Technically. But because everything doesn't work in unison, because it doesn't all move in lockstep, in all reality, what happened? Well, what happened in the last year? Let's see. I can buy twice as much ARK because the ARK fund went down, got cut in half. What was the price of Bitcoin a year ago? I can get more Bitcoin than I could a year ago. So I could buy that. So I had a put option on ARK fund. I had a put option on Bitcoin. What else can I buy more of than I could buy a year ago? I mean, we could look at any chart and we can say from today's date, 1 year ago, can I buy more or less of that good? Can I buy more or less of Zoom video than I could a year ago? Well, you could buy way more. Can I buy more or less of Facebook than I could a year ago? Well, you could buy way more, but now it's called Meta. So the real thing that people don't understand about cash is, no, I do not want to sit on cash for a long period of time. That is correct. I don't want to be some old, grandpa who saves up all their dollars from waiting tables at the diner for 50 years and puts them in a shoebox under their bed and never buys anything. That is definitely correct. And that's the person that has lost a massive amount of their purchasing power over time. I don't want to be that person. But I do want to have an active and open put option on the market where we're in a massive bubble that says, sure, Maybe if I go out and try to buy a used car now, I will have lost 10% of my purchasing power, because if I would have bought a used car a year ago, it would have been cheaper than it is now. Therefore, I would have to pay more money today for that same used car. Sure, that's an anomaly. That's not normal. So say I had more than $100 and I was going to buy a house. And I say, okay, well, housing went up 30% this year. So you lost. You're dumb. You lost 30% of your purchasing power, because now that house that was $100 is now $130. Sure. Okay, I did. So I just don't buy that house. I just don't buy that car. But there's a million other things that maybe I do want to buy, because I don't care what I want to buy. I didn't put that money aside. I didn't put that $100 aside and say, one year from now, I want to take this $100 and I'm going to buy a used car. Hooray. And then I go to buy that used car and I'm like, here's $100, sir. And he's like, this used car costs $110, sir. And I go, oh man, that's not what happened. What happened was, I have a bunch of investments already. I want to invest on other things in the future, but I don't like the prices of those things. So I actively open a put option in the market by saving those dollars. So I'm saying essentially, I bet that the market will be cheaper somewhere, some market, something that I want to buy is going to be less expensive 1 year from now than it is currently. So correct, I would have lost purchasing power if I went to buy a used car. I would have lost purchasing power if I went to buy a house. I would have lost purchasing power if I went to buy a pound of beef or a gallon of gas. Sure. But some of those things, if I bought a gallon of gas a year ago, it would not still be good. So I can't just buy a ton of gas and just stack it up. It would probably still work okay, but it's not going to be as good. It's not going to be that fresh gas. Some of it might have evaporated. Maybe it got some water in it. Maybe I used it up in the meantime. Whatever the situation is, there's always other X factors outside of that. But the fact of the matter is that there's many things in this case, that $100 can buy me exponentially more of. So you argue that inflation ate away 7% of my buying power based on a basket of commodities, the CPI. I argue, well, I can buy 30% more Russian stock as of 1 day ago, because Russian stock market dropped by 30%. I can buy 25, maybe 10%, maybe 50%, maybe 75% more of a random United States company that got absolutely wrecked over the last year because, we have like a stealth crash going on. So you have to look at it a little different than just this like cookie cutter, like here's a picture of a dollar. Here's a chart laid over top of it and you lost all your buying power because dollars are garbage. Sure. But we have to look at the big picture, because we're not just dumb apes that see something like that and then immediately say, oh my God, they're right. Spend your dollars as quick as possible. And that's the narrative that everyone is spinning. So that's it for our, deep dive into the purchasing power and everything, and talking about bonds a little bit. But I constantly am hearing the same confusion taking place with like the purchasing power of your dollars, with this fear of inflation, and not even just from the channel or people in the group or whatever, but like real life people that I know that are very educated, know all about stuff. My one, real life person has a doctorate, very intelligent person, and yet feels like the inflation is crushing them. And I'm like, is it though? Is the inflation collecting you or crushing you? Because don't you have a Rolex collection? Don't you have a collection of antique cameras? Don't you own a house? Don't you own multiple vehicles? So while you think you're getting crushed by inflation because you're paying more for a pound of beef or more for a gallon of gas, and you're believing this narrative, in all actuality, how much more money are you worth right now? Because your Rolexes are worth twice as much as they were a couple years ago. Your house is worth 30% more per year than it was, a couple years ago. Your cars have all gone up exponentially in value, when in all actuality, a used car should be falling. So a lot of people feel like this inflation narrative is hurting them, when in all actuality, if you netted everything out and you figured out your actual value, a lot of people are worth a lot more money and don't actually realize it, because you don't just sit around and say, hey, how much can I get for my house today if I sell it? You only look at how much your house is worth when you want to sell it. if you live in that house and you have no interest in selling it, or you drive that car and you have no interest of selling it, or you collect those Rolexes or old camera equipment that you've had for, 70 years or 50 years or whatever, and you're not planning on selling it, you don't go out every day and say, hey, how much is this worth? Hey, how much is this worth? You only do that with goods that you actively trade or purchase. So you might look at a stock price every day and say, oh my God, Zoom is worth half as much as it was last year. Well, if you weren't planning on selling Zoom, if that Zoom stock was actually just, a camera, you wouldn't know how much it's worth, how much it's trading for, because there's not just some chart you can look at where it tells you immediately the price of a camera. So that gives you a skewed idea. I think it was Warren Buffett who said, if you don't buy a house and then every day walk outside and your neighbor yells at you, hey, I'll give you $150,000 for your house. And you're like, no, I paid $160 for it. And he's like, okay. And then like the next day you walk out to get your mail and your neighbor's standing there at the fence and he goes, hey, I'll give you $200,000 for your house. And you're like, oh, that's a pretty good deal. No, I'm going to pass because I live here. I don't want to move. And he's like, okay. And then the next day you go out to get your mail and he yells at you, hey, I'll give you $193, $1,000 for your house. Like that was like an example he specifically used where, because we look at the stock market and you see every day what people are trading it for, what you could sell it for, etc., it gives us like this false idea of the value fluctuating up and down, when in all actuality, we don't go out and just price all our goods every day. You don't see how much your house is worth every day or your cars or whatever. So it's very important that we pay attention, to reality versus the narrative. And chances are, if you own a house or a car or, something like that, for most people, at least in the United States, something like 50% of their wealth, assuming that they're even like net positive, or maybe even they're not. But if 50% of your wealth is locked up in your house, and houses went up on average 30% over like the last year or two, like if inflation is at 7%, you are crushing the market. You're dominating the market. You're destroying the market. You are literally an amazing investor by doing nothing but owning a house. So sometimes like the actual picture could be a little bit skewed. We need to, kind of keep our heads screwed on straight and understand that the narrative that you're hearing is not always representative of the truth. So that being said, so we know everybody fleed to the bond market. We have a breakdown of the bond market. We talked a little bit about inflation and the fake inflation fears or real inflation fears, but the actual reality of the diminishing returns or depreciation or whatever you want to call it on your buying power because of inflation versus the actual reality of it. And the fact that, if you own a house right now in the United States and you purchased it at 10 times your annual salary. So if you make $50,000 a year, you purchased a house that's $500,000. You probably took out a loan for somewhere around $400,000. So maybe you put 20% down, $100,000 down. You made a bunch of payments. Let's just say you made no payments. You just bought this house for $500,000 and you make $50,000 a year. So sure, now all of a sudden, 1 year later, that house is, instead of being worth $500,000, it's worth, just for simplicity's sake, let's say 20% more. So let's say now, instead of $500,000, that house is worth $600,000. You paid $100,000 up front for it. You literally just took your $100,000 that you paid, and now your house is worth $600,000. It was worth $500,000. So if you were to turn around and sell that house right now, and that, not taking into account costs of, the real estate and the sale and taxes and all that stuff, you now get $600,000 for your house. You pay off the remaining $400,000 that you owe on the house, and now you literally took your $100,000 and you turned it into $200,000. So sometimes people don't take into account that factor. And then on top of that, what happened in the meantime? Well, maybe you didn't get a raise and you're still making $50,000. So over that year, you are making still $50,000 a year and everything costs 7% more. So you lost 7% purchasing power on your salary because of inflation. But by purchasing that house and the appreciation that took place, you actually doubled the amount of your investment. Not to mention the investment is substantially more than your annual salary. It's actually 2 years worth of salary that you put down on it. So yeah, sure, you lost 7% of your buying power in your salary because of inflation. That sucks. It does. It sucks to pay more for gas. It sucks to pay more for groceries or a babysitter or whatever it is. But what doesn't suck is that you literally just got 2 years worth of salary for free because you got that much appreciation on your house, which is a leveraged bet on a piece of property and, you know, a place to live, that you had $100,000. Now it's $200,000, assuming you just went and sold. But people don't realize that. They don't see what happened there because they don't just go sell their house. Now, granted, it's tough to take that into account also, because then you would have to turn around and buy a house from somebody else that is overpriced because it went up 25% in the last year too. But all things aside, without taking into account a bunch of these extra forces in the markets and reality and everything, in all actuality, a lot of people are doing better than they realize. It's the people that don't have anything, that don't have investments, that don't have a house, that don't have some big leveraged loan at a super low interest rate. Those people are the ones that are getting screwed. Those people are the ones that are getting crushed, because the people on the top are crushing it because they own a ton of stuff. The people on the, you know, upper middle class that own, you know, a house and a couple other things, or, you know, maybe a Rolex or whatever it is that you collect, they did pretty well. The people on the bottom, sure, their life still sucks. They're still below the poverty line, but they got a bunch of free money from the government. They're getting 25% more food stamps. They're getting a bunch of extra aid from the government. So sure, they're doing way better. Their life seems amazing. They're like, this is great. I didn't even have to go to work, and I got paid more than I got paid before. And the government gave me all these extra tax credits. And it's, you know, it's not even really a tax credit because I never pay any money. And now they're just giving me more money. So is that even a tax credit? No, because a tax credit should be that you just get back more of your taxes. You're not getting back more of your taxes. You're getting back more of my taxes. So those people are all doing great. It's the ones in the lower middle class. Those are the ones that are getting destroyed. It's the younger people, the younger generations that haven't yet been able to purchase those appreciating goods, whether it's stocks, whether it's cryptos, whether it's a house, whether it's a Rolex, whether it's, you know, whatever. Those are the people that are getting screwed because everybody else benefited from what took place at their cost. So that's why it's so much more important to keep all this stuff in mind. So let's keep moving on though, or this stream's gonna go for like $100, but that was just some topics that had been discussed or requested, or, you know, kind of we needed to like keep in mind here. So what do we see on oil? So we've been talking about oil. You know, I was calling out that this was potentially the top right here. You know, we have obviously had the same thing happen over again. We had this happen. This was our Russia scare. We had a massive wick up here. It looked like, you know, oil's going to the moon because Russia's not going to sell it to people, or there's going to be war, or whatever the scare factor is. So it pumps up here. We talked about it hitting this potential Fibonacci level here in green. It did, of course. And then what happens? I mean, that's a blow off top to me. That's a shooting star candle. That's a reversal candle if I've ever seen one. That's a stop hunt, whatever. And now we're bearishly engulfing. So we're basically now, you know, taking out weeks worth of price action, because if you would have bought oil on, you know, February 22nd, you're actually down now. And in the meantime, what happened with oil? Well, it went up, you know, massively. And now here it is even lower. So this looks like a blow off top to me. I don't think oil is going to zero, but it probably has topped out, at least for now. Let's look at the VIX. So we see obviously the stock market and crypto and a couple other things are doing pretty good today. And it's like, but wait, I thought World War III, shouldn't everything be going to zero? Well, the reaction rally was the VIX shoots up to the moon. It goes wild. There's massive volatility. Everything sells off. It dumps. And then Biden comes out and, you know, like, pulls everybody close and kind of like puts his hand on their shoulder and like kind of touches like the small of their back, maybe like a little bit lower, kind of creepy. And then he kind of leans in and whispers something in your ear and just kind of gives you one of those Biden sniffs. You know, he gets a little creepy, but overall, you know, he exhibits some strength. And the market said, you know what? I'm okay with, you know, Biden kind of touching the small of my back and kind of leaning in and just awkwardly smelling me. I'm okay with that because at least he's showing a little bit of strength. So, okay. All right. So that was, you know, the VIX shot up. Everybody's scared, doesn't know what to do. Biden pulls him in close, makes him feel uncomfortable, but a little better. And then, you know, that's the VIX coming back down. But was this unexpected? No. Because what's the market do? It moves up in a stairway. It moves down like a stairway. You know, when we're in an uptrend, it takes 2 steps forward, 1 step back. 2 steps forward, 1 step back. When we're in a downtrend, it takes 2 steps down, 1 step up. 2 steps down, 1 step up. You know, and that's what we're looking at. So here we have a very clear, defined range on the VIX. This is our ascending channel. And what did we do? Well, we just shot up from, basically the bottom of the channel to the heart line, consolidated, then to the top of the channel. And now here we are back down at the heart line of the channel again. The main levels to watch here are that we don't violate our descending channel line that we broke out of. We don't want to go back down into that. And if we do, we want it to be something like this, where we touch down, come back down towards the bottom of the channel, and then consolidate above it. So overall, this still looks good. Nothing changed in the VIX. It still looks great. We just saw a little bit of that volatility, which is, what the VIX is really measuring. So now let's look at the Dow Jones. So here we had this descending channel on Dow Jones. We talked about a high, we talked about a low, we talked about a lower high, and then we talked about a lower low that had already confirmed. So what happened now? Well, we broke down from that. We came back up and filled the gap, because obviously this is where the candle opened. Then we sold off massively. Then Biden came out, did his little scratch and sniff. And then the price action came back up. We closed the gap. We retested the breakdown from that descending channel range. And then today we had a powerful move back in, because everybody was like, buy the dip, buy the dip, buy the dip. This is it. We're going. Deep value territory. All in. Because people are still in that mentality, buy the dip. Did anything change from a couple days ago to today? Did anything get better? Is there more or less chance of war? Is there more or less chance of issues in Taiwan? Is there more or less chance of issues in Canada or Europe in general or China or, whatever? I would say now there's more potential for issues, because we crossed a line that we can't uncross. Putin went into Ukraine one way or another. Did he start a world war? No, I don't think so. Did he do some stuff that could be perceived as, hostile? Are people dead now? Yes. So I would say that is less stable. That's less good. So the market is responding to that by saying, okay, there's less stability now. There's more volatility. So in March, when Jerome Powell comes out, what's going to happen? Well, they're less likely to do a 50 basis point hike, because now shit's crazy. I mean, because the gas prices might go up, and there might be a world war, and food's going to go up. And so there's no way Powell's going to raise it 50 basis points now. There's no way we're going to get, 12 basis point hikes now in the year. No way. Now it's 3. Now it's 2. Now it's 1. Now it's none. They can't even hike at all. He's going to hike one time, 25 basis points, and then everything's going to crash, and then he's going to have to walk it back. Like now it goes, 2 weeks ago it was, we're going to get nine hikes. We're going to get 10 hikes, 12. We're going to get 250 basis point hikes. I mean, think about how dumb the market sounds right now. The market is literally your neighbor yelling at you. Hey man, I'll give you $100,000 for your house. And you're like, dude, leave me the fuck alone. I'm getting the mail. I'm not selling you my house. That's what the market sounded like last year, or last week. There's going to be 12 basis point hikes, 50%, this, that, the other. It sounds stupid. It's like your moronic neighbor yelling prices at you. And then, now it's like, oh, okay, so that went down in Ukraine now. So now you go out to get your mail, and all of a sudden it's like, oh, well, Biden came out, scratch and sniff some people, and made them feel good about themselves. So now all of a sudden the neighbor's like, hey, I was wrong about yesterday and offering you only $100,000. I'll give you $200,000 for it. And you're like, bro, what changed between then and now? Not that much. But the market is trying to figure out, and that's why the volatility is so important, because it's measuring the difference between what Farmer John is going to offer you one day and what Farmer John's going to offer you the next day. And when it's not volatile, you might walk out to get your mail and he offers you $150,000 one day. You walk out the next day and he goes, hey, I'll give you $153,000, $155,000, $157,000. That's like what a normal market is when it's just kind of melting up and volatility's low and everything's good. Right now we get these massive swings because we're just repricing every day. And one day it's 12 rate hikes. The next day it's 3. One day it's guaranteed 50 basis point hike in March. The next day it's not possible, maybe not even any rate hikes. That's what we're seeing right now. So nothing has changed though. We're still in a bear market, right? We're still under the 200 exponential and simple moving average. We're still in this channel going downward. We're still clearly in a downtrend. We have a high, we have a low, we have a lower high, we have a lower low. The only difference is, we took our 2 steps down and now we're taking our 1 step back up. And then after that, what's going to happen? Well, we're probably going to take 2 more steps down. So, that's the market just overreacting in one direction or the other. It overreacted to the downside ahead of everything. Then shit hits the fan and then it overreacts to the upside a little bit. So here we have the S&P. S&P obviously broke down. We already had confirmed in a downtrend. We talked about how this was the next key level to watch, and violating that level was going to look, bad, obviously. We did. We violated that level. We shot down here super low, back to a level all the way back from like May of 2021. And then, of course, you know, shot back up from there. But what are we doing now? Well, we're just retesting the 200 breakdown. I mean, we're just about up at the 200 exponential. 200 simple still looks like it's about to roll over. Did anything change? No, we have a little bullish divergence potentially. Potentially. But did anything change for the better? Is all of a sudden now the market's great? No, it's worse now. Because at least before, the Russia thing was just a threat. It was just a possibility. Now, it's happening. It's much worse. Literally, people are dying. There's literally blood on the streets. So is this just the market overreacting? Is this just the market trying to take advantage of the situation, assuming that Powell now is not going to do rate hikes? That's exactly what it is. That's exactly what it is. So IXIC, Nasdaq, same thing. So we broke down from that key level. We obviously had this key level in green right here. We had touched it once. We broke down from it. We're paying attention to our measured move, which we nearly completed. We didn't quite get there, but now we're pushing back up. We're still very much in a bear market. You know, we'll see kind of the oscillation of the 200 simple as it's basically flat, how it can switch back and forth from like pink and blue. But we know that in order for this to actually confirm back into a bull market, we have to close back above 14,741. So even though we see the slope on this kind of changing and it's like, we're in a bear market, we're in a bull market, we're in a bear market, we're in a bull market, we're in a bear market. No, I mean, we're in a bear market. Once it flips over and they're both red and we're underneath them, we're in a bear market until we reclaim it, basically. Because if nothing happens and just time goes by, this just looks worse and worse and worse. We have to have an aggressive move back to the upside to reclaim it. So when you see this kind of like chopping around right here, it's only just because it's slow reactive, because we're looking at 200-day period or 200-week period, depending on what time frame we're looking at. But again, we see potential for a bullish divergence right here. So sure, maybe this rolls back over, things look good, but you know, it's still, nothing has changed for me, in my opinion. It's likely that maybe we do come back up here. Maybe we do retest some of these levels. You know, that's what we talk about. We talk about that reversion to the mean play all the time. It's like the last ditch effort of the market to try to reclaim these key levels before we confirm to the downside and see continuation. And I believe that this is one of the last buy the dip, you know, attempts. And I think realistically now that we're confirmed below these, you know, even the people that did buy the dip, even the bots, even the algos, even the, you know, the buyers down here, most of them, the intelligent ones, the experienced ones, are probably just buying the dip on a scalp trade and still intending to sell the rip. I know I personally, you know, on Bitcoin, bought the dip and I already took profits on part of my trade. I still have part of it open. I have 50% of it open still, but I sold the rip. I bought the dip and I sold the rip. So while we're converging and while we're determining the direction of the markets, the whole way up, we're constantly buying the dip. The whole way down, we're constantly selling the rip. And then somewhere in the middle right here, the reversion to the mean play is the last big play I like to do where I buy the dip and sell the rip. Or same with like the topping pattern right before we convert into a bear market. That's like one of the last times, or when we convert back into a bull market, we'll get back on top of the 200 exponential and simple. The slope is starting to curve back to the upside. We're starting to confirm a bull market. We have sort of a parabolic move to the upside. Everybody's like, this is it, a big bull market. And then even though technically we're in a bull market, I will still sell the rip. And then I will buy the dip when it comes back down to the 200 exponential. And that's the same move we're seeing right now. We're turning into a bear market right here. So I'm still buying the dip right here, but I'm also selling the rip. And the same way that this happens back here, where, you know, we go into a bear market right here, and then we move up, and a lot of people sell the rip into the 200 exponential and simple, and then we, you know, hang out for a little bit, and then we finally come up here, and then again, I'll sell the rip again right here, even though technically we're going into a bull market now, and then I will buy the dip on the retest once again, assuming that it holds up. The same way here, I will buy the dip on the breakdown, and then I will sell the rip on the pushback up. And then after that, you know, the trend is confirmed. It's very clear that we're going higher. The trend is confirmed once we sell the rip right here, and then it's very clear we're going lower. So that's, you know, this is the area. This is kind of like that chop where there's a lot of volatility or whatever. There's a lot less volatility when we're very clearly in an uptrend. There's a lot less volatility when we're in a downtrend, but there's still more than when we're in an uptrend. But right now, this is maximum volatility when people are like, we're bullish, we're bearish, we're going up, we're going down, buy the dip, sell the rip. It's like, oh, what do we do? What do we do? Your neighbor's yelling crazy price at you. Do I hear 100,000? I'll give you 50,000. I'll give you 150,000. I'll give you 200. Do I hear 50? Do I hear 75? It's like an auctioneer out there yelling price at you. And you're like, bro, just shut up. I'm not selling you my house. So let's keep moving here. Okay, hopefully we're touching on some like key points and laying out some important ideas. Obviously, remember, if you're just tuning in, this is not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. I'm going to take a drink really quick. And all right, so XLE, energy, obviously very important, as this is composed of oil, or at least like some of our oil producers. So if you're not playing obviously oil in like the futures market or whatever, the easiest or main way to play them is obviously through like various companies or something like the XLE energy ETF, or something. You can play it in an energy fund. You could buy Chevron. You could buy whatever it is. But essentially, this is looking like it's starting to roll over. I mean, we've been discussing this. We saw two pretty bearish candles. We are holding on to the 21 for now. We're seeing a little bit of a bounce today. We see what's happening with oil. Nat gas is getting a similar move, I believe. I looked at it earlier. Obviously, oil looks like a blow off top. Yeah, the nat gas chart looks basically the same. Now it's not at the highs in the same way. It's basically just at like the heart line of that ascending broadening wedge, but it has that massive rejection, that massive spike rejection, and then pretty much like a bearish engulfing candle, or big red candle going into full effect right now. So this does look like it's going to roll over, but again, very much in an uptrend, and we would expect essentially somewhere around that $58 level is where we're going to look to reaccumulate on this, which by the time the 200 exponential and simple continue to trend to the upside, that's probably going to be right around where the 200 exponential and simple are. That's going to be our value area, right around 58, 60 bucks, something like that. Which is still like a 12, 15% move to the downside. So still a nice little area to take profit and then reaccumulate. So XTN, transportation. So obviously we're talking about this. This is a key one. This is one of the horsemen. Very important levels right here. More importantly though, what are we seeing right here? Well, it's that same volatility. We bounce the 200 exponential and simple. The 200 simple goes above the 200 exponential, telling us we're losing strength in the trend. We still put in a new high, which happens very often, and we talk about that all the time. Even though the trend is weakening, we still put in this isn't technically an all-time high, but a cycle high. And then we come back down, retest, lower high, retest, break, retest to try to reclaim, break lower, retest to try to reclaim again. Maybe we even reclaim them for a little bit, but overall, we're essentially just confirming a bear market. We know that this has to consolidate above 88.50 and stay there long enough to start building momentum back to the upside and start sloping, curving, moving these back to the upside. Is it possible? Sure. I mean, we're basically neutral right now. But the fact that we haven't seen a move like this happen, we've been in a very bullish posture, for the last year, almost 2 years. We've been in a very bullish posture. The fact that we're even threatening this right now is like, okay, wait a minute. Something's not right here. Looks like we're probably going to roll over. Even if we don't, we can always just buy back in if we reclaim these levels and we do get continuation to the upside. But at least for now, what we're seeing is this more than likely has topped out. So people are like, yeah, but look at that giant green candle. It's bullish now. Let's go. And it's like, yeah, but what did that candle really do though? I mean, it made up for the gap down, that fear. It, took out half the candle before it. And now where are we at? Well, we're just right back at those neutral levels. So this is just chop, in my opinion, right here. So doesn't look any different to me. Looks slightly better, but overall doesn't change the posture of the trend. Still looks very toppy to me. I think we have a... I thought I had a chart on here. We still have something like this going on. Shouldn't use the channel. I should have used the... Well, I think if we do it like this... we have basically something like this going on. We have this little like kind of outlier right here where we tried to break out and then it failed. But in all reality, we're basically just in a descending channel, right? So as long as we're in this channel and we have this little spike out here, this little guy right here, we don't worry about that little guy, but we know very clearly we have two strong points on the bottom. We have 1, 2 with a little outlier and then a third strong point on the top. And then this line now, this descending resistance of the channel also lines up perfectly with our 200 exponential and simple and this little chop right here. So in all reality, if you ask me right now, hey, did transportation just top out on that reflex rally, on that bounce? I would say yes, it did. And more likely than not, this now rolls back over and then heads back down to the channel. And we just keep going lower and lower. And now we know a key level for transportation is that low from back here in July. That, you know, that final test of the 200 before the 200 simple creeps up on top of it. And in all reality, you know, that's the key level that we're watching, because if we come back down to that level again after two touches right here and the previous one right there, this is going to start looking like a double top. You know, this is going to start looking like, you know, kind of like that Bitcoin chart where it's like, okay, we're having a little bounce right here. We're trying to reclaim the 200 exponential and simple, but more likely than that, we're rolling over and we're going lower. So, and then we know what happens when transportation tops out. You know, that's probably things are slowing. Because if all of a sudden transportation's been going up parabolic forever, everyone's paying more to ship goods, services, people, you know, in the form of, you know, airplane flights or rental cars or whatever. If it costs more to move stuff or people or things or goods or whatever, we know that as long as those prices are going up, you know, the economy is going strong because you're having to pay more to transport things. When we start to see the demand coming down or the supply of transportation picking up, whether there's more rental cars, whether there's more flights, whether, you know, there's more freight container ships, whether we're more efficiently getting the ships unloaded, therefore it frees up some of the ships that are just parked somewhere, whatever it is that we're talking about. As we see the pressure and the pricing come down on that, we know that probably that means, you know, things are topping out. So if we see the transportation starting to top out, we know more than likely the economy is probably like slowing down a little bit, or at least supply is catching up to demand, or maybe supply is catching up and demand is starting to, you know, go down. Whatever the situation is, you know, there's really only two factors. There's supply and demand. And when there's too much demand and not enough supply, the prices of the supply go up until they level out in a free market. If there's too much supply and not enough demand, the prices of the supply go down until the demand meets back up with them. So, you know, in a free market, essentially, which again, we don't need to talk about, oh, but it's not a free market. Oh, it's not capitalism. It's crony capitalism. It's communism. It's blah, 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 blah. Who cares? None of that matters. We keep everything simple around here, and then we can make it more involved over time. So let's look at the financial sector. This is a key one as well. What's going on with banks? Everybody's talking about banks, and they're like, banks are the place to be. If interest rates go up, banks are going to crush it. Banks are going to do well. Banks, 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 banks. Invest in banks, banks. JP Morgan, banks, banks, banks. No, I don't agree with that. I think that's wrong. I think if right now you think banks are great, you're probably not that intelligent, or you're probably old. You're probably stuck in an old way of thinking, okay? Because old people, people that are experienced, that are wise, that have been around for a while, they still think banks are good. They still think that a bank is a good thing when rates go up. But in all reality, let's think about this for a second. What is a bank? Okay, what is it really? It's a business. Okay, so what is the main business of a bank? Well, the bank borrows your money, right? You give them your money, and then what does the bank do with that money? Well, it uses that money to make money itself. So how does it use that money? Okay, maybe it loans it to somebody else for their business, and then, you know, captures the spread on the interest rate. Okay, maybe it loans it to somebody for their house and then captures a spread on the interest rate. Maybe it invests it into the markets or speculates on stocks or assets or, you know, essentially a business. So in all actuality, banks have done really well with super low rates because they're speculating on things in the market, not because they're giving out loans to people. It's because they're buying back their own stock, or they're buying other stocks, or they're investing that money. Because their job, their whole game plan is to borrow your money, use that money to make money, and then pay you a percentage on the money that they borrowed from you, which is extremely low. So we know that the way things have been going over the last couple of years, that the banks are less reliant on your money because they don't have to keep reserves. The government is backing them. They have a bunch of programs in place, you know, essentially like the repo market situation, all this other different stuff going on, where now the banks really don't even need your money nearly as much. They actually have like a bunch of capital that they can do whatever they want with. And they also like don't really need to like give people loans. They're like, wait, we don't really need to give people loans. Not just because the rates are low because they're just capturing a spread anyway, right? If they're borrowing your money at, less than 1%, much less than 1% in most cases, and then they're turning around and loaning it to someone else at, say, 3%, they're really capturing like that 3%. But in all reality, they probably are just borrowing money from the Fed at 0% and then turning around and loaning it to people at like 3%. So again, they're just really capturing that spread. So say they're making that 3% spread. So if all of a sudden the Fed funds rate goes up to 3%, and they're like, okay, Fed funds rate's 3% now, so we're still just going to capture that same spread. We're still just going to capture 3%. So we're just going to charge people 6% for their loans, for a house or for their business or whatever. So now they're still making that same spread, that same 3%. So it's like, oh, banks make more money because interest rates are up. So that's good for banks. So that's the old person's mentality. That's the less educated, less savvy, less free thinking person mentality. If interest rates go up, banks will do better. Okay, but now let's take into account reality and let's use our brains and not just say, cookie cutter bank, interest rate go up, we make more money, bank good, we invest in banks, yay. No, that's dumb. That's the stupidest thing I've ever heard. Let's talk about why. If you're getting money for 0 and you're making 3% on it, or let's say you're getting it for 0.5%, let's say, because we can't multiply by 0 or divide by 0. Let's say your banks are getting their money, Fed funds rate, at 0% because they have an account with the Federal Reserve. 0% from the Fed funds rate. And they're getting 3% for it. So they're making 6x because they're getting it for 0.5% and they're lending it out for 3%. So they still pay back that 0.5% that they borrowed it at. And then they make 2.5%, the spread on that. So now let's look at it. Okay, now Fed funds rate goes up. Banks make more money, right? Sure, yeah, because then they just charge more money. So banks good, they make money. Okay, let's do the math here. So if Fed funds rate goes up to 3%, and now that bank turns around and gives that same person the loan, but now instead of a 3% loan, they paid 3% for the money that they borrowed from the Fed. So now they have to give it to you for 6% because they're still going to capture that same 3% spread. So now they are getting it at 3%. That's the cost of them borrowing that money. And then they're making 6% on it. So then they're net gaining only 3% now. So they're net gaining 100%. Well, a minute ago, they were getting it at 0.5%. And they were giving it to you for 3%. So their 0.5% cost of doing business or cost of borrowing that money was, over 5xing, 6xing basically, because the 0.5% was yielding them 3%. Now that 3% is only yielding them 3%. So it's much worse for banks if rates go up. Not to mention what happens when rates go up. The risk goes up substantially to loan people money because you have an economy full of zombie companies and all of a sudden the rates start going up. It's like, oh wait, now valuations come down. All of a sudden those houses might not be worth as much and people might be underwater in their loans. All of a sudden those stocks might not be as much because future earnings are going to be much lower than they were at 0%. All of a sudden businesses might start going under because we may be going to a recession. So it gets exponentially more dangerous for the banks. So sure, they're capturing a spread. So if interest rates go up, that's good for the banks. Sure, it is. It's good, technically. But in the example that we just gave out, does it seem like the banks are in a better position at 3% interest rates with potential, defaults on housing loans or business loans or layoffs because the economy is slowing or a recession or depression or whatever? Does it seem like they're in a better situation then? Or does it seem like they're in a better situation when the Fed funds rate is at 0? Because to me, someone with a brain that's actively using their brain, not some old boomer that's stuck in the old way of thinking when it's like, banks make money on spread, interest rate go up, bank good, yay. No, that's a brain dead way of thinking. It took us 2 minutes to explain why anyone that thinks like that is brain dead. So in my opinion, I don't think banks look particularly good right now. I don't think the future for the banks looks particularly great right now. Because where are the banks really making their money? If we dive deep into where JP Morgan is really making its money, where is it really? Is it making it from giving out loans to people, or is it making it on stock buybacks and speculating in the market that's been in a parabolic uptrend while we had zero rates, and they were making a massive spread based on the cost of the money they borrow versus the cost of the loan that they do give out, if they were giving out loans, which statistically speaking, we know that they're really not giving out loans the same way that they were 6 months ago or a year ago or whatever. So they see danger in the future. The market looks weaker than it is in the future. You know, the discounted cash flows into the future of all these different businesses or speculations look worse than they do in the future. Most companies aren't even giving like forward guidance or estimates. So these smart people who borrow money and speculate with that money, because that's their whole business, aka bankers, don't think the future looks particularly great. But everybody else is like, oh, but the banks, they're so good. Invest in the banks. The banks, the future, the rates are going up in the banks. Yay. Well, to me, those people sound stupid. So we'll see what happens. Maybe I'll be wrong. And the boomers will be like, we told you the banks. Maybe not. But to me, doesn't look particularly great. Now, the chart looks okay for now. 200 simple is above the 200 exponential. We did put in a new high for now, but now we have a high. Now we have a lower high. Now we have a low. Now we have a lower low. So financial sector does not look particularly amazing to me. Now, it still looks better than a lot of things. But when we really talk through these things and we talk, you know, like reasonably discuss these things, and we start talking about the actual spreads of the money that they're borrowing and, you know, what they have to pay out and how they're actually making their profits and the risk of them actually giving people loans. And when we really take all this stuff into account, it's common sense that probably the banks had it the best they're ever going to have it. And that from here on out, the outlook is probably worse, in my opinion. Maybe I'm wrong, though. What do I know? So Vanguard, emerging market fund. So we talked about this. We went into a deep dive on basically these various emerging markets. And we talked about the risks and why the dollar is so much stronger than everything else. Because, well, Canada, because, well, United Kingdom and Brexit, Canada, the truckers and the, you know, we're stealing your money and, you know, we're dictators now. And now there's new laws that you can't do stuff, even though it's legal, because we now made it illegal. So now we're going to take your money and your stuff and confiscate it. You know, whatever. Do you agree with that? I mean, whatever. Do you agree with the mandates? Do you agree with the, you know, totalitarianism? Do you agree with the dictator? Do you think, you know, Trudeau's handsome? I mean, I don't care. I don't really care about any of that stuff. You could say yes to all those things. You could say no to all those things. But regardless, Canada does not look like a stable, safe place to put your money right now. You know, so, and then we look at, you know, obviously we see what's going on with Russia and Ukraine, Europe. You know, let's look at Germany. Let's look at France. We're having an energy crisis. We're shutting down, you know, nuclear power plants. We're, you know, against Nord Stream pipeline all of a sudden. Like there's a bunch of stuff going on. Do we want our money there? No. So we don't want it in these unstable regions. UK's got Brexit. We've got all this stuff going on. So emerging markets don't look good to me. Now, same thing happened. We broke down from our key levels. We're trying to push back up. This had a much weaker move back up, trying to at least come up here and close the gap. But again, looks terrible. It did almost come down to our long-term blue trend line here, though, almost perfectly. So we know other people are looking at the same thing we're looking at. We reclaimed support. We almost touched our ascending support. And we confirmed that everybody else is doing the same thing we're doing. And we're still very much in a bear market. And we still very much do not want to be in emerging markets. Regardless of everybody being like, yeah, but emerging markets are cheap. Sure, maybe they're cheap for a reason. Because they're risky as fuck. DAX. So let's look at Germany. So obviously they have a lot going on right now. You know, we're sanctioning, you know, Russia and now Nord Stream 2 and now that's not going to happen and it's full of gas, it's ready to go. And now, you know, price is going to go up on the stuff and who knows, and there's instability and we don't know what's going to happen. So this looks like an even less stable chart right here. Very much in a bear market. We break down, we push back up. It barely even closes the gap. But, you know, the American markets gap down, came all the way back up, and then shot back up a majority of that move. So we see that these are selling off aggressively, and then they're bouncing aggressively, but much less aggressively because there's a lot less stability or a lot less certainty as to what's going to happen here. So again, don't want to be involved in Germany right now, you know, in my opinion. Now we do have a clear support here, a little bit lower. We made it the majority of the way to that support in a single, you know, candle, but still not excited about it. China. So how does China look? Okay, so what happened with China? We see China had a little sell-off, push back up here a little bit, but I mean, it doesn't look particularly great. It definitely didn't have the same move that we saw in like the Dow Jones or the Nasdaq or the S&P. You know, didn't have as aggressive of a sell-off as Germany because it wasn't as scared, or emerging markets, but you know, doesn't look particularly great right here. Looks a little more stable, but it's at support. And where does it look like it's going? I mean, we're at support right now, technically, like maybe broke down through it, very much in a bear market. So if you're like, hey, does this look like a good buying opportunity for China? I'm like, yeah, maybe right here as we're retesting, you know, what was resistance as support, and we're expecting to go higher, maybe here, and then we go higher, we start peaking out, and then it's like, yeah, maybe here for a reflex rally, maybe here for a reflex rally, reversion to the mean, and then it's like, okay, this isn't bad, we got a higher low, and then we get a higher high, so it's like, okay, we're starting to trend up here, that's not bad, and then you break down, we come retest it again, and you're like, hey, is now a good time to invest in China? I'm like, I don't know, man. This looks pretty weak to me. We bounced support a bunch of times. We're putting in consistently lower highs. We're right back down at support again. It looks like we're ready to just fall through this. This is our bouncy ball. We drop it above the table. It bounces. It bounces. You know, maybe the first time it doesn't hit the table. Maybe it hits our can of Coke that's sitting on the table. So it bounces off the can of Coke. Doesn't even make it down to the table. Bounces off the can of Coke. Then it comes down all the way to the table. Then it bounces a little bit, you know, comes back up. And each time it bounces up, it bounces a little less high up. And then eventually it's almost not bouncing at all. And it's just kind of rolling. And it's rolling and rolling and rolling. And eventually the table ends. And then what happens when the ball rolls off of the table? You know, it falls. There's a waterfall. It falls off the edge of the table. And then what's the next thing it bounces off? Well, maybe it's, you know, whatever's on the floor next to your desk. So maybe it's not all the way going to hit the ground. Maybe it hits your, you know, if your computer's sitting on the floor, or maybe you have, you know, a pair of shoes, or something you bought off of Amazon sitting there ready to get unwrapped. But in all reality, it looks like we're getting ready to like waterfall off of the table. So this doesn't look good to me. I mean, we're at support right now, or at what was resistance that turned into support, and we're just hanging out. We're just hanging around. So more likely than not, it looks like we're about to fall through this area. So here we have the UK 100. So this had a pretty aggressive move back to the upside. Obviously, we see, you know, a very nice bullish engulfing candle all the way from our retested the 200 exponential and simple all the way back up here, trying to reclaim key levels. Still looks overall decent, better than emerging markets, better than China, better than a lot of these things, because it's on top of the 200 exponential and simple. Now, granted, this is just the UK 100. So this isn't like an accurate view of like obviously all, you know, United Kingdom stock market, etc. But overall, this chart still looks strong. So the fact that we got that nice bounce off of this, if we actually consolidate here long enough, the 200 exponential crosses back to the upside, this probably starts looking good again. And then it's like Brexit, we don't need no stinking Brexit, we're fine. So we'll see what happens with that one, but that's probably the strongest one of those that we've looked at now. So let me jump in the chat and see what's going on, and then we'll keep on ripping through, guys. Milligan, here we go. Loud and clear. Thank you, brother. Appreciate that. Honkiness. Dude, what if that whole time I never looked over and it was like, we can't hear you, bro. Your mic's off. Oh, man. Would you guys have missed out on some fucking valuable info there. I appreciate it, though. Honkiness says, let's do this. Or just do this. Soto says, hi, everyone. What's up, guys? Good to see everybody. Milligan says, such a valuable lesson already. Thanks for putting everything in perspective for us. Really helps me to get the big picture. Fuck yeah, bro. That's what it's all about, man. You know, there's so many people that either don't understand a topic fully, like that are here talking about things, or influencers or whatever, that can't put everything together, or they have a couple pieces of the puzzle and they're teaching other people because they understand one thing. Very few people have a complete grasp of so many things, you know, and part of it is just because I'm so passionate about, you know, economics and investing and all these things that I'm constantly evolving as well. But I have a very good grasp on the big picture, even like the geopolitical portion of it as well. So, you know, and then obviously I love teaching, sharing my knowledge, all this good stuff. But I think you'd be surprised how many people know a ton about like one thing and then don't know shit about other stuff. Like there's a lot of really, really smart people. I was talking to you about my doctor friend. He's extremely, extremely smart, a savvy business owner. He has, you know, made millions of dollars and had, you know, phenomenal businesses and, you know, brought products to market and has patents and, you know, obviously very, very educated, very intelligent. If I start talking to him about the Federal Reserve, he has no fucking clue what I'm talking about. If I start talking to him about, you know, the like what I was saying about the housing and all his assets going up in value and his Rolex collection and all this stuff, and then he's worried about inflation, it's like, dude, no, you don't have to worry about inflation because you're crushing it. Your inflation is great for you because you're beating inflation substantially. So many people are like that, where they have this very niche specialty, and it's not this. It's not this field. It's not global economics. It's not, you know, all these different things that we talk about, you know, all of these moving pieces and everything. So I think it's very important to kind of put things in perspective sometimes. And while occasionally something will be a little redundant, or maybe a lot of time, I don't know how redundant I am to you guys. But, you know, I never know when I have a new viewer or somebody that doesn't have a good base, or I will just repeat something the same way that when you first meet someone and you repeat their name a few times, you're less likely to forget it. If you meet someone and you shake their hand and you're like, hello, my name is Crypto Trend Trader. And they're like, that's nice. Nice to meet you, crypto guy. You know, as opposed to if you just say it over and over again, Crypto Trend Trader, Crypto Trend Trader, Crypto Trend Trader, Crypto Trend Trader. It's more likely to stick into your memory just because that's how the human mind works. The same way I like to create that foundation and continually come back to it. And then we come back to the foundation again. It's like, oh, we already learned about the foundation. It's like, yeah, but today we're building a garage. And then we start framing up a garage on the foundation. And then the next day we come back to the foundation. And you're like, yeah, but we already know about the foundation. It's like, and today we're going to be, you know, laying some electrical. And like we're slowly building this house on top of the foundation, but we're putting all the guts in and going through as we go. And it's so freaking important because it's easy to go off on this tangent and start talking about like yield curve inversion and this, that, and the other. And then the whole time we forget about all these other key components because you're like, oh, I'm just watching yield curve inversion because that's the most important thing to see if we're going into recession. And it's like, yeah, but you forgot about semiconductors. Yeah, but you forgot about energy prices spiking. Yeah, but you forgot about transportation. And it's like, damn it, forgot about all those things because we were just focused on the cost of money. And so that's why I try to like always bring it back to that center. I try to revert to the mean of knowledge, and then we can kind of go off on our little tangents from there. So let's look at some more stockaroonies. So obviously going into the close today, you know, Friday. Oh, hang on one sec. Going into close today on Friday, you know, we got a couple hours left in the market. We had a nice little bounce back up on a lot of things. It's good. We don't want to see the market close just absolutely wrecked after, you know, a week of just bleeding out. We want there to be some kind of life still out of it. So let's look at what the DXY did. We already looked at, you know, what energy did, oil prices, etc. So let's look at the DXY. So the DXY has spiked to the upside too. That was that safety trade, safety play. You know, again, we put in another higher high based on a wick. Did not close above that high, but we closed at a key level. You know, basically just above that previous one here. Not quite above this one right here. Now we're seeing a little weakness. Still looks very, very strong to me. This still looks very strong. Very, very strong. So DXY looks extremely strong. The weaker we see Canada look, the weaker we see, you know, UK, which looks okay today. You know, the weaker we see Europe in general, the weaker we see, you know, all these other things looking, the better the dollar looks, the DXY looks. So not a ton has changed right here. Basically just consolidating. This still looks like a bullish reset to me. Here, price action was right here. And now where are we at right now? We're at the same spot, right? So the price was here. And then all this time goes by. And we oscillate up, we oscillate down. And then where are we at? Same place. And then let's look at our indicator oscillator. So this is where the indicator oscillator was before when price was at that level. And now here's where the indicator oscillator is now when price is at that same level. So what's going on here? Price is going sideways. You know, it's oscillating in that range, but it's going sideways. And the indicator has gone way, way down. So what does that tell us? It tells us eventually the more it goes down, the longer it goes sideways, the more it just kind of chills out here, the more likely it is to have the ability to go up. It's hard to go up from here because we're already at such a high level. We're at a spike. We're really, really high. There's no energy left to go up anymore. And then we try to go up again. We go up higher in price, but we don't have the energy to go up again. So that's where we see like that bearish divergence. So now we're just resetting that. This to me is a bullish reset. Again, same thing right here. Look how high the energy was on the stochastics. We're all the way up in the bullish control zone. We're up at 93. It's out of 100. We're at, you know, the highest it can go. Here we don't go up quite as high. We see that bearish divergence. Price action goes higher. Indicator oscillator goes less high. And now here what happens? Well, now we've put in a lower high here, at least temporarily. And now look where the indicator oscillator's at. Now we're only at 65. So here we were at 93 was it, right? I think we said 93, roughly 90 something. And then here we were at 80 something and we were much higher. And now here we are at 66 and we're much lower than those previous two, but the price action is still in the same spot. So this is just a massive bullish reset. And typically what happens after a bullish reset is, you know, picture a plane flying through the air and it's running out of gas. You know, we're running out of gas on the indicator oscillators. We can't just keep going up forever. So then, you know, we refuel midair. We don't come back down and land. We didn't come way back down and land. We're not back at the airstrip, you know, loading back up for the next flight. We're still here flying. We're just coasting. We're barely burning any fuel. We're refueling midair. And then soon we're going to just take back off again. And that's what this looks like to me. And that's essentially the mentality behind a bullish, you know, reset. So let's look at Tesla. Tesla had a nice move back up. Everybody's like, oh, Tesla, $100 move. It's amazing. I mean, but is it though? Does this look good to you? Tesla bounced. It went to 700 and then went back to 8. Oh my God, that's amazing. It capitulated to 700. You know, it opened up from 760 down to 700 and then it closed the gap and went slightly higher. That's great. That's super bullish. Tesla had a $100 move. But let's look back more than one day. Where was Tesla the day before that? It was at 830. It was at $830. So it was at 830. It capitulated down to 700 suddenly. And then it pushed all the way back up and now it's at 800. So Tesla sold off massively and then it gained back some of the massive move. So now it's still down, but it's only down $30. And everybody's like, Tesla, I bought the dip. It's amazing. I'm up $100. Sure you are. You did. You bought the dip. You did great. You bought it 700 and now it's at 800. Congratulations. But if you bought any time before that, you're still down $30. So let's not get too excited about Tesla. I hear everybody's like, that's it. I'm buying the dip. Cathie Wood bought 100,000 shares of Tesla. It's going to the moon. No. But just as a general rule for now, and this is not financial advice. I'm not your financial advisor. You know, do your own research. I'm not telling you what to do or anything. But for now, I think as a general rule, whatever Cathie Wood does in her life, whatever life decisions she makes, whatever investment decisions she makes, I think it's probably wise to just do the opposite. Do the opposite. Whatever she does, do the opposite. That's for me. That's what it is. There's actually a fund specifically for that, SARK, where they're like, hey, whatever Cathie Wood does, we're just going to do the opposite because she obviously has no idea what she's doing. But I mean, not financial advice though. Not financial advice. But, you know, there's that old adage, markets are easy. All you do is just buy low and sell high. Cathie Wood's like stuck on opposite day. She's like, I just buy everything high and then sell it low when it's in deep value territory. But anyway, I'll stop ripping on Cathie Wood, even though it's fun. And it's easy. It's easy. It's like, you know, beating up a little kid. Can't defend itself. So all Tesla did, bounced that key support level that we were talking about. It came back down to the red support right here. It bounced it, still below 200 exponential, still below 200 simple, 200 exponential slope to the downside. Very, very close, Tesla, to actually confirming into a bear market for the first time in a long time. Since Tesla was $52. So it was $52. It went on an epic bull run, and now it's $800 and all but confirming into a bear market. So when people are like, yeah, but it's already down. It was 1,200 and now it's 800. It's in deep value territory. And I'm like, I mean, is it though? I mean, like $80 is probably deep value territory. Maybe $188 is deep value territory. Maybe $400 is deep value territory. Maybe even $557. There's some value. But at 800, is it cheap now, or is it just less overpriced? Is it a good deal, or is it just less of a bad deal? So Intel still looks like total trash. Obviously the worst of the semiconductors. Had a nice little bounce up here, but we don't even really need to pay attention to that. Let's look at Nvidia. So Nvidia had that big move down below the 200s, came back up, reclaimed them for now. Still has the 821 cross to the downside. Still very much operating inside of our descending channel or descending broadening wedge. Almost hit our target. Very, very close to hitting our target of 200. Again, I still look at that initially as a buying opportunity. I did not catch the move on Nvidia. You know, sometimes target doesn't get hit, you miss it. I'm not going to chase it. I think more likely than not, it ends up down here eventually. You know, maybe we just got front run slightly. Doesn't matter. 200 simple about to cross above it. Maybe Nvidia does go up to a new all-time high, but we definitely see the strongest semiconductors and the weakest semiconductors look like they're rolling over. So overall, I would say in general, semiconductor space looks like it's probably maybe getting close to at least topping out. So if we know Nvidia is basically the strongest semiconductor stock, and we're going to use this as a proxy, because instead of just looking at all the semiconductors together and saying, okay, what's the semiconductor space looking like? Because that's one of our horsemen. You know, we could look at an ETF or something like that, like SMH or something. We could do that. But instead, we're just looking at like the strongest. We have like Nvidia or AMD or Micron or something like that. So we're just looking at the fastest horse to see, hey, if this horse is tired, and then we have like our Intels over here, which are like 3 legs, almost dead, like getting ready to just get dragged outside and shot. And then there's a bunch of like mid-range, you know, semiconductors as well. We're like, well, if the best one is tired, if the strongest one is tired, the fastest one is tired, whole space might be getting tired. So that's why we're looking at Nvidia as more of a proxy of the strongest, because right now the strongest are the most important, not so much just like the average in general of these indexes. So Nvidia has now, you know, 2, almost 3 bearish candles in a row on our monthly here. And now this monthly ends in 3 days. So if we close below the 8, we're probably coming down to 21. So at that point in time, Nvidia is down at 191 and it has wiped out 1, 2, 3, 4, 5, 6, 7, 8. We're back where we were 9 months ago, you know, in one of the best stocks in the indexes. And by far, well, arguably, depending on what time horizon you're looking at, the best stock in the semiconductor space. So if we see more weakness in Nvidia, if we close below the 8, that will be our first close below the 8 in, you know, a long time. The last time we were below the 8 at all was back here in October of 2019 when Nvidia was $43. Now it's $238. So we had no closes below the 8. So this looks very, very toppy to me. Very toppy to me. So we'll see what happens in the next couple of days as this monthly closes. But we know for sure that 193 looks definitely in the cards. You know, and semiconductors as a whole looking pretty weak right here. I mean, it's definitely possible we end up with maybe not something quite like that, but I wouldn't be surprised if this is a big, thick red candle in the next few days by the time this closes. So, and then obviously we see a sell by sell, and we have officially left the bullish control zone. We are out of the bullish control zone. We no longer have the red highlighted area, and we know each time that has happened previously, we get the sell by sell. When we leave the bullish control zone, we see a pretty big capitulation. Sell by sell, leave the bullish control zone, probably looking at a pretty big capitulation. Again, we see kind of choppy right here, but this was basically a sell, buy, sell, buy, sell, buy, buy, sell, sell, buy, buy, sell, sell, buy, sell. And then we saw a pretty heavy move to the downside. So, you know, is it possible? Obviously, the 821 in order to cross, we'd have to come back down here. The 8 has to get dragged down. Eventually, we consolidate long enough. Then it rolls over. Then the 821 crosses. Then we revert to the mean. Come all the way back down to 200 exponential. And so we'll see what happens, you know. But this is one of the first steps. We're seeing some definite weakness in the semiconductor space, telling us, hey, maybe this is topping out. Netflix doing nothing, basically just bouncing that ascending support, still very much under our resistance, has hit the measure move breakdown from the channel, just kind of hanging out here, trying to build some strength. Now, to me, this looks like a bearish reset. The same way we had a bullish reset where the price, the indicators, the oscillators was at one level and then basically just went sideways, and the indicator oscillators were going down on the dollar, on the DXY. Indicator oscillators are trending back up. We had a huge spike down. It trends way back up. You know, we're now approaching the 0 level again. You know, trending back up, cross back down, trending back up. And where are we at? Well, I mean, we're just at the same spot again. So is this just going back to neutral? before it has another heavy sell-off and breaks down from support again? I think so. We lost key levels already. So we're at some key levels, taking a little pit stop. But the longer these go up and the price just kind of goes sideways or chops around here, the worse it looks. And I think there's a very, very good possibility Netflix is down here at $260. Matter of fact, $260 is my target for Netflix, where I start paying attention again. I think there's a very, very high likelihood that we end up down here. Maybe in a couple weeks, maybe a couple months, maybe in a year. I don't know. You know, maybe our next earning. I don't know what's going to happen. But we're at 386 now, so 260 is a pretty hefty move. Another 33% down. Apple next. So Apple had a nice bounce perfectly off the bottom of our channel, off the top of the resistance turn support, and off the 200 exponential and simple. So very much just playing by the rules. It's a good little Apple. You know, back up here towards the top of the range, probably comes back up, puts in a lower high, rolls over. Doing nothing differently. 100% what we would expect from Apple. So good job, Apple. Let's see. Amazon, same thing. So Amazon comes back down here, retest the bottom of the channel. Retest the bottom of the channel, has a nice little bounce back up, trying to cross 821 back to the upside. Couldn't even get to the heart line yet. Couldn't even get back to the 200 exponential and simple. Very much still in a bear market. Getting absolutely hammered. You know, obviously from when we talked about this. Now, granted, keep in mind, I did not short Amazon. I was using this as an example. But if you just closed your position on that short, you're already up 12% on the Amazon short. You know, obviously now it's less because of the bounce or whatever. But our target is still very much the measure move to the downside and the break of this range. Amazon looks very weak right here. Still looks very weak. Much stronger than most things. And when the strongest things look weak, like the Nvidias, the Amazons, the Apples, you know, what does that say about the actual market? What does it say about all these shit stocks that everybody's like, oh, I loaded up my bags on Tattooed Chef. Oh, I'm such a dick. So Google, Google as a company, obviously great, a phenomenal company. I mean, just have the best values, the best morals, the best, you know, ability for me to just get on YouTube and just talk to my community and just do things and stuff as well. Loving YouTube and just Google is just great. I love them. They're just phenomenal. But as a stock though, Google, don't listen. Cover your ears, Google. Cover your ears, YouTube. Okay? Because I'm about to spit some truth. This looks like shit. It looks real bad. 200 simple above the 200 exponential. Okay? Broke down from a couple times. It already kind of flipped it over bearish. This is flattening out. And where are we at now? Well, we had that bounce. We had that aggressive move down. We put in a new low. We gapped down. We came back up. And now it looks like we're getting rejected at what was support, now acting as resistance. And I don't know why I don't have any lines on this chart. But if I did have lines previously, there would be one right here. There would be one at that resistance, at that support, you know, broke down, reclaimed it. And now here we are at it again. So right at the 200 exponential and simple. So we really don't even need a line because everything just lines up. But it looks to me like what's about to happen. Well, this thing was crushing. And now it's like, I don't know. Where's it going to go? Is it going to go back to $1,500? Probably not. Is it going to go back to, you know, $2,000? Maybe. You know, is it going to go back to $2,300? Probably. So, you know, and we can do stuff. We can draw fancy lines and charts and use tools and everything, or we can just look at, like, you know, areas that just kind of jump out at us. You know, look at this one, how technical this is. So does it look like we topped out now? It kind of looks like it to me. I mean, if this is our low right here and we see some clear resistance right here, and then we break up, hit the next level, come back down to the 200, break back up, consolidate above the 618, come back up to the 0.5, see that as a key level. Then we come up to the 382, that's a key level. Then the 236, that's a key level. Then all the way up here to the top, and we finally top out. And then all of a sudden now we can draw this, and we're like, wait a minute, it's almost like this was planned by bats and algorithms and market makers. Well, so we know that they probably just hit their targets based on how much confluence we see when we look back at it. So more than likely, our next target to the downside is going to be this 236, 2336. We already knew that, though. We didn't need the Fibonacci. We just looked at it. It was obvious. And now once we put the Fibonacci in place, it's like, well, of course that's the 236. Of course this is the 382, $2,000, $2,300. And I promise I didn't look at this ahead of time. This same thing. It works because it works. Everybody's doing the same thing. All the smart people, all the market makers, not the influencers, not the fundamentalists, you know, not the buy the dips, not the Kathy Woods, but the people that know what they're doing, market makers, the dollar takers. Microsoft was able to reclaim that level, basically bouncing the heart line of our giant head and shoulders, retesting 200 exponential and simple. Still looks absolutely terrible. I mean, is this just a high, then a low, then a lower high, then a lower low? Then are we just going to put in another lower high at like 305 or maybe at 300? Probably. And then what? I mean, probably going to get that measure move. So we already put the fib in place for this. We're already paying attention to these key levels, and we'll keep our eye on it. But we know very much we're at the 236 and we're headed to the 382, more likely than not. More likely than not. Unless we reclaim the 821 and the 200s and start consolidating there and reclaiming key levels, we know more likely than not we're headed to the downside. Now, this whole market could just turn around and all of a sudden it just gets thick and juicy again and we just get bullish and everything's green and it's amazing. But we're going to see that coming. We're going to know. We're going to have tons and tons of things telling us that's what's happening. It's not just going to all of a sudden happen. But we see a little bullish divergence. We had a little bounce. We had that reversion to the mean. So no surprises here. Market is trading very, very technically. Everything is. All the stocks we looked at are trading technically. The treasuries we looked at are trading technically. The oil chart is trading technically. The VIX is trading technically. Everything is trading so fucking technically right now. If ever we had an advantage in these markets with our technical analysis, if ever the market was bent over and we were behind it, breathing heavy and making it our bitch, if ever there was a time, it is now. It is right freaking now. These markets are so technical. I mean, we couldn't ask for more technical, more beautiful markets. Everything we're doing, the market is doing the same thing. Whatever we're doing, our techniques, our strategies, our tools, everything that we are doing, the whales, the market makers, the 1% or 0.1% or whoever you manipulating or whoever, whatever you want to say, however you want to refer to these people, the elites, you know, the ones in control, the aliens, the whatever you want to call them. I don't care. Okay. But regardless, we know the bots, the algorithms, the AI, whatever it is, whoever's in charge, whoever's doing the stuff and the things is doing the same stuff and the same things as we are. And that is what we want. That is the best case scenario. Peter Gerd says, do you see the large tech companies like Facebook, Metro, dying slowly in the future, 5 to 10 years? Some of them, man. It's kind of like, that's a super broad question. Meta in general, if you came back from the future or I came back from the future and I was like, hey man, I got to tell you something and you're not going to believe it. And then present me is like, I don't know, I'll probably believe it. What is it? But also, you know, can I borrow your time machine? And then future me is like, dude, Meta peaked out and it's burning massive amounts of cash by the millions and hundreds of millions and billions. And it's never goes back to that all-time high again. And Meta as a company dies. But, you know, something else swoops up or like maybe like, I don't know, one of these other companies or, you know, one of these other platforms, you know, is doing great. I would be surprised. Not at all. Not at all. Not even a little bit. You know, Meta, Facebook, to me, is a dying company. You know, it's no young people are on it. It's not onboarding new users. It has clearly peaked. The same way that I feel about stuff like Netflix. You know, I think Netflix has probably peaked. I don't know that Netflix ever does better in the future than it's done. I don't think it ever has another Squid Games. I'm not sure that it ever, I mean, it might have another Squid Games, but I don't think it ever has the reaction it had off of Squid Games. I don't know that we ever see some of these companies back at all-time highs again. You know, I think that a lot of these companies are going to be dot-com bubble burst Cisco's, you know, where they never return to previous all-time highs. Now, certain companies, for sure, you know, if you told me Apple hits new all-time highs, but it takes a couple of years to get there, but eventually it doubles, I'd be like, sure, I believe that. If you tell me Amazon, you know, is the biggest corporation in the world 10 years from now, and they own everything, and the government's a part of Amazon now, I would be like, sure, that makes sense. You know, there's certain companies I'm super, super bullish on long term, regardless of what the chart looks like right now. Most of these companies, though, most of these tech platforms, most of these, you know, social media platforms, I think probably have a rough road ahead through either government regulations or aging population that doesn't give a shit about them anymore, or like the new cool thing comes along. Like we know from things like, let's say, look at a crypto. Let's look at Cardano. Okay, Cardano is already very big, large market cap, big following. You know, it's obviously very hard for Cardano to implement smart contracts. Maybe because Charles Hoskinson's full of shit. Maybe he's a bad dev. Maybe the platform's just so big it's hard to, you know, move because you're moving a Titanic instead of moving a little like speedboat. Whatever your reasoning is. Maybe Charles Hoskinson's just a scammer, loser, piece of shit. I don't know. I mean, I know what I think. It's probably a combination of all those things. But we know that in the last few years, while Chucky has been working on his smart contracts, that a bunch of other companies have just popped up and are like, hey, look, we already have smart contracts and we're not even, you know, nearly your size and we're just crushing it. Look, hey, smart contracts left and right. Oh, look. And then meanwhile, Charles is like going on live streams just crying because he's getting delisted and he's mad because the market's not being patient with him after, you know, 4, 5, 7 years, whatever it is, of broken promises. So I think a lot of these big companies are going to have trouble pivoting as the world evolves around them, or adapting or implementing these new things that they're promising or hoping to do or whatever. So if you ask me, do I think Meta is going to be the metaverse in the future or whatever, or are they just changing their name to try to capitalize on a trend? What I see when I see Facebook change their name to Meta, I see two things. I see one, they're trying to help their PR because Facebook is a shit company and they're garbage and they're like have a horrible reputation. But you're not going to like trick people. They're not like, oh, what's this new Meta thing all about? And you're like, oh, I don't know. I never heard of it before. And you're like, wow, Meta. I keep hearing people talk about the metaverse, so maybe I'll check it out. And then somebody's like, I mean, that's obviously Facebook, dumbass. And they're like, oh, yeah, it is Facebook. Oh. Bah. So I see that. And then I see like a little hint of like the blockchain iced tea. You guys remember that back in like 2000? In 2000, like companies were literally like changing their names to like, you know, what was it? What was the iced tea company? I can't even remember. They changed their name to Blockchain Iced Tea or whatever. And it's like, oh, well, what's this company? Blockchain Iced Tea. That's the future. Blockchain, crypto, invest. And the price like spikes. But it's just like an iced tea company. And they literally just put blockchain in their name. These people are dumb. And that's what it looks like to me. That's what this Facebook Meta thing looks like to me. It looks like a combination of trying to capitalize on a future trend and trying to change your name so people don't know that you're a piece of shit. That's what it looks like to me. So some of these companies go away. Some of them just never recover to all-time highs. Some of them do better than ever. I love Amazon long-term in the future. I think it crushes it, not as a company, but, you know, as an investment, as a stock, whatever. But Facebook, no, the opposite. Netflix, I don't know that Netflix is better in the future. I mean, right now, I would say I have a slight bias to no, it's not going to be a winner in the future. And then, you know, we could go down the list on a bunch of these other ones. I think something like Instagram has a much better chance in the future. You know, Snapchat probably looks better. But, I mean, what's the one? Weeble? No. What's the Chinese one? Damn, I can't think of the name of it. It's like crushing everybody and they're all complaining about it. And, you know, Trump had like sanctioned them or whatever. Oh, man. I'm so out of touch with social media, man. Yeah, I can't think of the name of it. But you guys know what I'm talking about. That's like the one that everybody's involved in. And then, you know, it turns from a social media platform, Weibo, turns from a social media platform to like a payment processor to like, you know, a combination. And then you register with the government. No, I don't think that's right. It's, oh my God. It's the one where TikTok. That's the one. TikTok. Where everybody's like dancing and doing stock advice and all that. TikTok looks like it's probably the one that's going to crush everybody going into the future, in my opinion. You know, and you can do payments through it. But Weibo, I think, also is like their social media, like Facebook or whatever. So right along those lines. So let's just jump back in, keep on moving here. So let's talk about, we'll do crypto last, and we'll do a deep dive into that. But we'll take a look at the commodities real quick. So let's look at gold. Okay, so what happened with gold? Did it do exactly what we said? Did it literally do exactly what we said? Gold had obviously a spike based on fears. If we look back, where did that spike take us to? Back to these levels. Never closed above it. Back to these levels with the wick. Could not close up there. Massive spike rejection. Blow off top, it looks like to me. Got rejected. Could not get above the 618. And now we're bearishly engulfing. Just wiping out these candles. Waxing that ass and headed down lower. So are people now going to be trapped inside this as it now uses this as a throwover and breaks down from here and then loses 45% of its value and goes down for the next like 5 or 10 years? I don't know. Too early to tell, but I wouldn't be surprised. I would not be surprised. So let's look at a longer time frame. And this is exactly what we were talking about. Right here. This is exactly what we did. Right here. That 2012. We look like we're breaking down. It looks like a descending triangle. All of a sudden we get a breakout of key resistance. We move all the way back up. We retest what amounted to like basically like a triple top lower high. And then we just slowly roll over into a bear market. So here we have a slightly more bullish pattern, a little more of like a neutral triangle. You know, we get a nice bounce. We take out that high. We take out that descending resistance line, the triangle that we've been forming right here. We come back up. We get a spike high. We get rejected. Now this looks horrible. When this daily close or this weekly closes today, this is going to look so bad. I mean, this is literally a topping candle. You know, it's a shooting star, 100%. Prices broke out, went super high, and then got completely rejected. Not only did they get rejected back to where they started, but now they're negative. So we have a red candle that's all wick, barely any body, and a clear rejection of higher prices. So the same way this looked bullish, the same way this looked bullish, this looks bearish. So I think we head straight back down to the bottom of the range. So I think gold's going back down to like 1740, possibly even to retest the low lows at like 1700. This is terrible. I mean, maybe it rallies in the next 3 hours and 40 minutes. But to me, this is exactly what we were warning about, discussing about, obviously not financial advising about, but looks terrible. And then, you know, actually, what was that? The weekly I just looked at? Let's look at our monthly now. The monthly doesn't look nearly as bad. You guys know that my rule on a candle is 50%. I don't want to see 50% of a candle get eaten by the next candle or 50% of a candle be wick. Because if I see 50% of a candle be wick, it tells me more likely than not that whatever direction that was in was a rejection and we're probably going in the opposite direction. So when we see a big wick candle like this to the downside with over 50%, much more than 50%, this is basically a hammer telling us we're rejecting lower prices, we're going higher. You know, the same way that this is a big indecision candle, this tells me, you know, that we're rejecting higher prices. We're probably at least revisiting the bottom of the range. So, and then obviously, you know, looks bearish, trying to move back to the upside, trying to cross the 821 back to the upside. You know, again, very similar to what we did right here. Let's look right here. This, we're selling off, we're finding support, we're moving back up. You know, we're below the slope line, we're touching it, we're reclaiming it, we're flipping it back over blue. We're getting ready to cross the Stokes back to the upside. Things are looking good. They're looking juicy. They're looking thick. Gold's going to new all-time highs. And then rejected. Minus 50%. And you just wasted, you know, a decade of your life. So what does this look like right here? Well, we broke down below the slope line. We're coming back up. Starting to looking thick and juicy. We're moving back up. Rejected. Maybe not. Maybe we reclaim those levels. About to cross the Stokes back to the upside. It's looking juicy. It's looking thick. We're about to go. Let's go. Let's go. Do gold all time high. Rejected. But what about the world coming to an end? What about the system getting crushed? What about the dollars are getting inflation? Whatever the narrative is. I can't even think of all the bullshit narratives of why all of a sudden gold's going to be great right now. Well, this tells us they're probably going to be wrong. We're probably going to go into recession, and then we're not going to be worried about inflation. We're probably going to, you know, turns out the world's not going to come to an end. So like everybody's like, world's coming to an end. We're going to need gold because the system's going to crash and we're done with this. And the Federal Reserves are done and people are tired of government. And more likely than not, we probably just keep doing the same thing that we've been doing. More likely than not, the same structure that's been in place that everything's built on top of. Probably just keeps doing the same thing. But it's unsustainable. Sure, you're right. Eventually it breaks, but probably not now. What was that? They were talking about people have been betting on the end of the world since it started. And, so far, nobody's been right. So, every generation, every time something big happens, oh, Ukraine, World War III, oh, Afghanistan, oh, the nukes, Iran, Iraq, Saddam Hussein, Taliban, World War II, the Nazis, whatever. How many of those times did the world end? Noah and the Ark, going way back. Kathy and the Ark. How many times did the world end? Well, so far, none. So I would say that, betting on things just keep on keeping on is, betting 1,000. So let's rip through the rest of these and we'll do some crypto. So obviously silver rejection looks horrible. Barely got above 200 exponential and simple. Got back to the hard line. Rejected hard. Doesn't look good. Looks much worse than gold. So obviously now when we look back at this chart again, we see that it still looks like basically we had a little rollover, reclaiming the 200 exponential. Probably move back up here next, assuming this holds. Looks like gold's probably headed back to like 82 silvers to 1 gold. XAU to BTC. So we came back up, retested that level. Gold's starting to look better there for a little bit, starting to look rejected. Basically probably just consolidates at resistance here for a little bit. And then one of these gets wrecked a lot faster than the other. And let's be real, if let's say, for instance, we go into a massive bear market on both these things and gold loses 45% of its value and goes down for a long time and just gets absolutely crushed. And then let's say Bitcoin, confirms that we've double topped, the 4-year cycle is still relevant, it's over, and Bitcoin just goes down and gets absolutely crushed. Well, historically speaking, we know gold typically sells off like 45, 50%. We know Bitcoin typically sells off like 80%. So that would be basically gold doubling in value compared to Bitcoin, because Bitcoin would be going down by 80%. Gold would be only going down by like 40%. So, it's still very viable, probably just chops around sideways for much longer. Or maybe none of those things happen and I'm completely wrong. Maybe gold goes to 10,000, and goes up 5x. And then Bitcoin goes to, 100,000 and goes up 2.5x. That chart looks the same either way, because it's the same exact move. It's just what direction it breaks out in if they both do the same thing. Silver juniors still look like trash, rejected at the same level, exactly what we were expecting to happen. Gold juniors rejected at the top of the channel, exactly what we were expecting to happen, rejected by the 200s, still look like total trash. They thought they were geniuses for one day. For one day, all the gold people and the silver people were like, ha ha, motherfuckers, told you. They're putting out like 5 live streams. Lynette Zhang did like a live stream with everyone she knows, like out here. Gold, I told you. World War III, it's over. This is the end. Gerald Celente, the Trends Journal. Fuck everybody. These fucking guys. Blah, blah, blah. Everybody's out here. Peter Schiff with the live stream talking about Bitcoin's garbage and gold's amazing. Everybody just jumping out here, putting out as much content. They got there one day to enjoy it. And now it's over. So I hope you had fun. And keep in mind, I like some of these people. And they do put out useful content sometimes. But you have to be able to sift through the bullshit. You have to. You cannot join a cult. Those people are all cults people. Anthony Pompliano, Bitcoin cult. Peter Schiff, gold cult. Michael Saylor, Bitcoin cult. Charles Hoskinson, Cardano cult. Maybe other cults as well. Some of these people might be devil worshippers. I don't know what other cults they're in. But we know for sure those people are in cults. Lynette Zhang, gold cult. We know these people are in cults. And this is an anti-cult channel. We're against cults. We hate cults. That's the last thing we want to be in. We're in the market tell us what to do cult. That's our cult. We don't decide what the market's going to do. We let the market tell us. Say no to cults. Don't be in an altcoin cult. Don't join the Doge cult or the Safe Moon cult. Don't get all pumped up on cum rockets. Don't do it. Just trust the charts. Don't get in the uranium cult. Don't get in the green energy cult. Everything is cults now. Don't do it. Don't do it. CCJ had a nice little move. Uranium had a pump, trying to reclaim 200 exponentials and simple, consolidating. Doesn't look any different to me. Slightly more bullish than it did before, but still doesn't look great. Pot stocks put in a new low and then just bounce back up, trying to reclaim those levels. Still looks the same to me. Again, another drive of potential bullish divergence. Sure. I mean, it's happened 1,000 times, so forgive me if I don't quite trust this yet. How many times have I said I'm bullish on pot stocks, but we probably put in a new low? Well, I'm gonna stick to my guns on this one, guys. You guys know that I typically don't flip-flop. I don't really change my mind too often. I pretty much just trust the chart. The trend is down. It's been down. You know, I'm going to say it one more time. You know, sure, we had a nice move in pot stocks the last couple of days, but would not surprise me to see another new low. And we almost got back down to, you know, the lowest low. So new all-time low on THCX, or, you know, insert random pot stock here. Probably. We probably do. But you know, if you look at these TV stations or channels or whatever, they're like, oh, this X stock is up 13%. X stock is up 20%. And then you're like, yeah, sure. So if you bought the absolute bottom on this one day, you're up 20%. But maybe you're down 77.8%. Because if we're going to pick bottoms and say if you bought the absolute bottom, you're up how much? Let's pick tops. Let's say if you bought the absolute top, how much you're down. So that was somebody's stop loss got hit, and then this just died. So, you know, let's just pick from the middle. So you're like, oh, I'm up 20%. And you're like, are you though? Are you up 20%? Or if you just bought anywhere randomly along the way, are you just down 52%? Because that's reality. This is just spinning a narrative. This is just using statistics to your advantage. So, but we don't do that here. All right, so that's it for our commodities. Let's look at these cryptos now. Peter says, damn, I just put all my money in gold. Bro, shut up. That's not funny, dude. Ralph says, I told you. Peter says, did you see the Peter Schiff versus Richard Hart? No, I heard him talking about it, and I know that is going to be exciting. I will, you know what? I'm going to watch that today. Is that up on, whose channel is that up on? Because as soon as I heard about that, I was like, oh, this is going to be fucking good. Because I like Richard Hart. Now, granted, I like him because he's an intelligent man. He's not a scammer, so to speak. Okay? I don't think he's doing illegal things. But I do think he's taking advantage of a niche market full of uneducated, moronic retards. Okay? So I don't think he's doing anything technically wrong. Morally, I think Richard Hart lives his life in a moral gray area. For sure. He's not doing anything illegal, technically, that I know about. But let's be real. Hex is, well, make up your own mind. But the idea of Hex is genius because you're exploiting something. But also, it's not illegal yet, but probably will be in the future. But yeah, I cannot wait to watch that. I love Peter Schiff's debates are great. Sometimes he's a little obnoxious, but usually it's because he's right and the other person's just dumb as fuck. I do love his debates though, but he is a little obnoxious sometimes. Richard Hart, very educated, great debater, massive amount of respect for that man for sure. But also he's definitely shady as fuck. But yeah, I definitely want to see that. Richard Hart did make himself look kind of dodgy. Well, he's a dodgy dude for sure. He's definitely dodgy. He doesn't even have to make himself look dodgy. He's just a dodgy dude. Like everything about it. I mean, I don't think he's ever been like secretive about like his dodginess. I mean, if you know about his history and stuff like that, you know, he's definitely shady. I mean, Hex is definitely, you know, well, let's just put it this way. Hex is sort of like, it's sort of like in between a NFT of something that has no value at all and a legit crypto project that will be around still in 20 years, or blockchain project or whatever. It's somewhere in between there. But there's a massive gray area, and Hex lives inside of it. You know, Hex is a smart idea that's basically built around the idea of bonds, the bond market. But it's also a borderline massive Ponzi scheme. So it's somewhere in the middle with a ton of gray area, but also technically legal. So you got to give the man respect for that. But also, it's like, if you know that you're creating a Ponzi scheme, but it's legal, is it shady or is it okay because it's legal? I don't know. It's such a big gray area. But it needs the Ponzi scheme. My precious Ponzi scheme. It needs new users. Yeah, oh, I mean, 100%. It 100% has. Anytime somebody tells you, hey, man, can I borrow $100 from you and I'll pay you 40% interest? But you only get the interest as long as you don't ever make me pay back the $100. And also, I'm not going to pay you the $40. I'm just going to write it down on the tab. So I'm going to borrow $100 from you, and then I'm going to owe you $140. So on paper, you're definitely making money, and you're getting an awesome return on your investment. But also, you can't ever actually get your money back, because if you do, there's going to be some penalties. And also, like, really, I mean, what are we really doing here? Well, we're increasing, like, the market cap of the thing that you invested in exponentially, because we're paying everybody based on how long they go without ever getting their money back. So you're getting more of the thing, but we're devaluing it exponentially fast by the more people that are in it and the longer they go without getting their money back. So it's basically a Ponzi scheme. But also it's legal. It's a legal Ponzi scheme. I don't know. I got to see this. It's probably awesome. It's probably amazing. I can't wait to see it. I think after a debate like that, like Peter Schiff and Richard Hart should like have a debate about like gold versus like Hex or crypto or whatever. And then afterwards, they should have like a boxing match or like a UFC cage fight. I think that there should be a battle of wits followed by a physical battle. I think that would literally be amazing. It would probably sell more tickets than a Jake Paul fight. Definitely put that on the list of shit that I want to see before I die. What's up, Mr. Lex? Good to see you. Sounds like a great scam. Yeah, I mean, again, though, it's technically not a scam. It is technically legal. But also, technically, the dollar is not a scam and is also technically legal. So if you don't like the dollar and you're against the dollar and what they're doing because they either devalue your dollar through inflation or through money printing, so they either increase the supply of dollars without anything backing it up, or they inflate away the buying power of your dollar. And that's why you like cryptocurrency, because there's a limited supply, and we're not even going to take into account all the other things that we always discuss about the problem with limited supplies and paper trading and all that. Take about all that stuff and just say, I hate the dollar because it's a Ponzi scheme. And then you're like, but Hex is good. And you're like, wait a minute, but isn't Hex just literally the dollar Ponzi scheme built on a blockchain? Because that's exactly what it is. That's, if somebody was like, hey, what's this new Hex thing? Should I invest in it? And I'm like, how do you feel about the dollar Ponzi scheme? And they're like, that's bad. That's why I'm looking to invest in cryptocurrency. I'd be like, well, it's that, but on the blockchain. It's just a digital version of the same Ponzi scheme, but somewhere else. So make your own decisions. You could say Bitcoin is a scam. Sure, you definitely could. Something only has value if people believe in it. Definitely. Sure, you could. There's different ways to look at it, though, because Bitcoin, at least you have people like mining it, securing the network. With Hex, it's literally like people just locking up, like their investment, buying Hex, and then they just get paid more Hex to lock it up. But if they take it out before their lockup period's over, they get less. And then everybody gets paid a massive amount of interest on their amount that they have locked up. But also, if you don't lock it up for the longest amount of time, you get diluted because they're constantly making more hex. So at least Bitcoin has a fixed amount. So prior to, the paper trading and all the futures contracts and all that stuff, prior to that, at least Bitcoin had 21 million limited supply. Hex is the opposite. Hex is constantly minting a ridiculous amount more hex to pay people a ridiculous amount of interest to lock up their hex to never take it out. So, I mean, it's basically like Bernie Madoff all over again, but exponentially worse. Richard Hart is like, hey, I'm not printing money, but I created a system on the blockchain that prints money massively and constantly dilutes you. Unless you lock up for the longest amount of time, you constantly lose value based on the dilution. But it's okay because you can take your value off of that and then buy actual things with the dollars, which is theoretically the reason you got away from the dollars to begin with. So it's a huge Ponzi scheme, let's be real. But technically it's not illegal, so. Richard Hart would never stop talking. Yeah, I can only imagine those two. That's why they should box at the end. But anyway, I'll check it out. I definitely am excited to see that. I'm not sure. Is it posted up on one of their channels, Peter Schiff or Richard Hart? Because I will definitely check that out. As soon as I heard Peter talk about that, I was like, oh, this is going to be fucking good. It took them 20 years before Bernie got... Yeah, of course, man. And how did he really get caught? I think like one of his kids narked on him, didn't they? I'm pretty sure it was like one of his kids who like either purposefully narked on him or like accidentally was like, my dad's running a Ponzi scheme. But like in not so many words. But I mean, there's so much shit that's illegal right now. And the regulators are like still trying to like, I mean, they're still going after Elizabeth Holmes. Like, let's be real. How many of these people are going to end up either, most of them are probably going to die from hard drugs way before the government ever comes after them for all these illegal things that they're doing in the market. I mean, I still think Elon Musk is going to get SEC action against him for his Twitter account. I still think that Dave Portnoy is going to have a lawsuit against him for his, ticker Scrabble at the beginning of like the situation where he was like just pulling out like Scrabble pieces and then he was like live on stream. Everybody go buy, THC. That was the Scrabble pieces we picked. Like all that kind of stuff. I mean, that's full on like legit pump and dump stuff. And he made some statements. I think a lot of people are going to get in some big trouble for that stuff. So that being said, looking at the Bitcoin futures chart, so we had a pretty big rejection of lower prices. Doesn't change much, but we do have technically a low right here and a higher low for now. But is this a swing though? Or is it just a little life before we roll over? We have to wait and still see. Bunch of red histograms, still a hard sell. We used to have a time when weekends were more bullish because the futures market was closed and it was just a cult playing. Now we really don't even have that anymore, so we'll have to really see. I don't know what's going to happen over the weekend. And we were trying to pick up a little bit of momentum. I do like that we're kind of bouncing the slope line here and it's still blue. That looks good on spot markets. We have a green histogram potentially. We have a rejection of lower prices potentially. I mean, that does look good. But on the big scale, we still have a high, a low, a lower high, a lower low, and then a lower high. So more likely than not, we just put in a lower low. But then when we zoom way out here, we do have a low, then a high, then a higher low, then a higher high, then a higher low. So technically, we're still in a macro uptrend. And then inside that, we're in a, smaller macro downtrend. And then inside that, we're trying to get back into some sort of uptrend. But again, you guys know how I feel. I'm not particularly bullish on Bitcoin right now. I think more likely than not, we get a situation like this where we get some kind of bounce and then just another massive sell-off. Or something like this where we get some kind of bounce and then another lower low. I think we're going to get something like that. Could we come all the way back up here and tag the 200 exponential or 200 simple? Sure. But, I mean, we very much have confirmed a bear market as of, February 19th. We've been very much confirmed in a bear market based on my strategy. So it's hard for me to get excited about this. On like a 4 hour though, yeah, sure. I took a scalp off the bottom. I took a scalp off the fib. I don't know if I have it on this chart actually. I know I shared it in the group. If we do We basically got pushed back up to the 382 on the macro fib right here. And then we've technically put in a higher low. And then if we take that one off, and then we do just a micro fib from the low right here to the little micro swing high right here, we basically came down and tagged the 886 perfectly. So I took a entry off of the 886, which is basically the last attempt. You could easily just bought like the 786, but basically got like a 2 fib level bounce from there. Basically just back to like retest resistance. Here we are at the 200 simple, you know, just retesting it as resistance. 200 exponentials up here at the 382. So I still have, I think like half my position open with the target of 40,400 for now. I'm not like loving this position. It's counter trend trade. We'll see what happens if we reclaim these levels. Maybe we go higher. If we get rejected right here, maybe we go lower. But just a little scalpy scalp, nothing crazy. But I didn't get all the way down on my entry. I want to say it's something like a 10% currently from where we're at. But I did already take some of the profits off the table on the initial move back up to the 200 simple. So, but again, counter trend scalp, less reliable, more likely than not going to underperform. Don't love it. Just a little quick little spending money. Little weekend money so I can lose it on the fights. God, my fight picks have been atrocious lately. Atrocious. I mean, I had a couple winners. The Tuivasa fight saved me from last week. I was bombing pretty bad. I basically just checked all the boxes for every loss. And then I was like, well, it's Tuivasa or nothing. And I wrote him off. And then, god damn. Straight up awesome. That was might have been 2 weeks ago, actually. Ethereum. I don't know. Time is a myth ever since the Rona. So, Ethereum does not look particularly great. Still looks very much like the Bitcoin chart. Very much has confirmed into a bear market. You know, potential for some shorter term divergence developing here. You know, if we look at our stochastics, we have a low right here. We have a lower low on the blue. Here we have a low. We have a higher low. So, you know, definitely some bullish divergence developing there. We do not see the same thing on the TJD, TDMACD. Very much in a bear market, though. Does not look particularly great. Bitcoin dominance, still just consolidating above those levels on the weekly. We see now the blue slope line. We have triple bullish divergence. The 821 getting ready to cross back to the upside. More likely than not, headed back to like 44. We'll find some resistance. Eventually, I do expect a breakout. And, you know, that will all but confirm that the bull market is over. Next, we have the crypto market cap. Again, rejection of lower prices. Hanging on to that 1.6 trillion level for now. Looks terrible. Very much in a downtrend. Very much probably continues in that downtrend. I do like the multiple rejections that are of lower market cap right here, but not getting overly ambitious. Solana basically came down to our target area, tagged it perfectly. You know, just shy of the 0.5, but hit our green box. So if you took an entry on that, congratulations. Probably does move back up at least to the 382. More likely, probably see it back up here at resistance at about 116. Yeah, I did not buy any shitcoins. I literally just took a Bitcoin position. I mean, I could have, definitely. Some of these look nice. Didn't quite get down to our target on Matic. Definitely just holding at that 0.5 for now. Did put in a lower low, so that does not look particularly great. Did finally complete the measure move, though. Almost perfect to the T from our initial breakdown. Still very much acting inside the descending broadening wedge. Looking like it's trying to confirm some bullish divergence. Excuse me. This probably does get a push up here. It's tough, though, because there's a lot of overhead resistance. The 618 or 382, and then the 200 exponential and simple, and the top of the channel. I mean, if this thing bursts the upside, though, it's going to be a nice trade. Not a good risk reward where we're at right now, though. Avalanche bounced to 786 perfectly. So previously, we had found support on the closes at the 886. Here we came down to the 786. So we topped out the 382. We went down a couple of fib levels. We're back at the 618. So maybe we get back up here to the 87 mark. Maybe we top out right where we're at right now. We'll have to wait and see. Shorter term Bitcoin chart right now looks like it's trying to I mean, honestly, the 15-minute, the hour, and the 4-hour all look kind of bearish right now. The 4-hour looks like sort of like a bearish engulfing candle. We'll see though. The 821 have crossed back to the upside. We do have a little hint of a blue slope on the 4-hour. So Luna still running. Obviously, that if anybody took that trade, you're absolutely crushing it right now. I obviously did not. I have no idea what Luna is. I had heard of it before, but never even looked at it until someone mentioned it. This is probably the best looking crypto right now, especially after this move. Definitely a nice move up here so far. Obviously, already tagged the 0.5. Next target would be the 618 at 74.85. Been a nice move already. We were talking about a 2-to-1, 5% move with 10% to the upside. At this point in time, it is far exceeded that. So, I mean, it's up 37% from then. So, probably not a bad trade if anybody took that one. Congratulations. DraftKings. Had a nice move. Everybody's like, DraftKings, it bottomed. It's amazing. Buy DraftKings. Yeah, hooray. We're crushing it. Up 33%. Where's it at? Resistance. Still looks like trash. People are like, DraftKings up 33%. It's amazing. It's great. Well, from the last little push right here, it's down 67%. From the all-time high. It's down 71%. So, it's all in perspective. It's all where you bought it at compared to where you sell it at. Because it could very easily just roll back over here and then just goes much lower, which is what I expect. I would expect that to happen. I would expect it down at 786. So, wait, what, a week from now, it's back down at 15. Right now it's at 618 at resistance on the channel. Maybe it breaks out. Maybe it gets a push back up to 0.5, goes to 26. Maybe the 382, the reversion of the mean, 200 exponential and simple. I don't know. I mean, it's going to depend on the market, but let me put it this way. I don't think right now is a great time to load up bags on a bunch of trash bag companies that don't make money. Is it a better time than right here? Yes. Is it a better time than right here? Yes. Right here? Yes. Right here? About the same. But yeah, that's it for today. I think we did it. We did it. We made it to the end. Happy Friday, everybody. 148. Nice. Peter Gerd says, took them 20 years before Bernie got caught. Oh, that's an old one. Yep, it was live on YouTube. Well, hopefully they post it back up here, man. I need to see it. I'm sure it's on one of their channels. Crime pays. It 100% does pay. NFTs prove that. Mr. Lex says, if my generation lives long enough, we are all going to jail. Peter says, could be a super massive bull flag. Great stream. Yes, got that Friday feeling. Yeah, hell yeah, for sure. If you're new to the channel, make sure you like and subscribe. Share with your friends. Yeah, not taking on any new group members right now. So if you already reached out to me, you are on the waiting list. We have filled up the last couple spots. Everything is nice. Got a nice full group of good people. And just not trying to... Yeah, so just for now, I'll let you guys know when there's some spots again, when we decide to expand it further, or if something opens up. If you have already reached out to me and I basically sent you back an email, you are on the list. It's in order of, who reached out to me. No, you cannot bribe your way to the front of the list. But yeah, I will let you guys know when that opens back up. But it is in order of people that have reached out to me. I've already responded to everyone. If you reach out to me and I have not responded back to you, I either will respond back to you soon or wait a couple days and then hit me up again because maybe it's in my trash inadvertently. So, but yeah, for now, no new group members. I'll let you guys know when I will take on some more. But for now, we're good. Yeah, I think that's it though. That's our Friday stream. Hopefully you guys enjoyed it today. I was a little late getting started. That is completely my fault. I totally lost track of time, and for some reason I just had like a full-on like senior moment. I was thinking for some reason that we were going live at 1, and then all of a sudden it was like 11:15, and I was like, oh shit, it's Friday. I'm supposed to go live at 11, not 1. What am I talking about? And yeah, so that's my fault. But hopefully everybody made it. nobody got too stressed out. Like, where is this dude? So, yeah. But good stream overall. I'd say going into the weekend, Bitcoin could go either way. Definitely looking forward to it. I'll be obviously active in the group, so we'll look for some good scalps. We will definitely be taking profits on the remainder of that position. If it looks like it's going to roll over, if it looks good though, we'll probably just ride it out. Got some nice targets in mind, some targets in play, and obviously like to lock in those gains. Always would rather take some off the table in profit than turn a winner into a loser. But that being said, I think we're going to wrap it right there. Appreciate everybody tuning in today. Appreciate all the new group members that we have and all the support that you guys have shown. But that is it for today. So without any further ado, it is Friday, It is Friday, 1:51 Eastern Standard Time on February 25th, 2022. And brap, that's a wrap. Remember, this is not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. Crypto Trend Trader, signing off.